Well, people have pointed to this idea that there's going to be less fiscal support than there was in the era of the CHIPS Act, the Inflation Reduction Act. Bank of America puts it at about a 5% drop in U.S. government spending year over year. How are you thinking about the U.S. fiscal impulse at this moment?
So the fiscal impulse, I think you have to keep in mind the CBO projections right now factor in the lapse of the Trump tax cuts. So both parties are going to keep, Trump obviously wants to keep it full stop. But, the Democrats, they're saying, 400,000 or below are going to keep the tax cuts. You add on to that, they both seem to be on consensus in terms of no taxes on tips. That's another tab. So you can start to see it start to add up. Like she mentioned before, Kamala Harris is talking about $25,000 tax credit. I know she wants to probably extend some of the tax credits that they had during the Biden's tenure. So all of that's adding up, and I think it's going to definitely, like I said, cause some volatility.
Just to sort of underscore this whole point, are you basically recommending to State Street clients not to go into long bonds?
I think I would be definitely skeptical to go into the long side right now of the curve. I think it's more secure to probably stay on the short end. And the Fed may cut rates. However, given how like I mentioned before, the economy is pretty strong, I think rates will, the Feds, they only could go so far.
Well, how far would long end yields have to back up for you to recommend them against clients?
I think they would have to get to 5% for me to feel comfortable recommending long end at this stage, and that's the 10-year.
And this is entirely because of political concerns, not because of what you're seeing with respect to potentially preemptive Fed cuts and just where inflation might be long term. This is having to do specifically with the deficit, correct?
It does, yeah. I think it's completely the fiscal situation that we find ourselves in, and I think it's just going to get exacerbated regardless of who wins. How
much pushback are you getting from clients?
I would say it's kind of mixed. I would say it's mixed. Some clients are, all in because their perspective is, global central banks are cutting rates, good environment to go into bonds. But some are starting to get concerned about some of the proposals that are getting floated around. I think they were caught off guard a little bit when Kamala embraced this, no taxes on tips, because that was something new. Now the thinking is, okay, what else could come to the fore? What else could be reintroduced here? So I think that'll, what she lays out later on today, what she kind of emphasizes during the DNC will be critical.
Noel Dixon, thank you so much for being with us. Really interesting. Noel Dixon of State Street at a time when we're heading into the DNC, and it seems like the biggest volatility, Emery, could come from the bond market, not the stock market.
Yeah, that's because of, to Noel's point, this political rhetoric and what rhetoric translates into policy. Remember, we're talking about also that the tax cuts are going to be a huge issue in 2025, but also we're on the fiscal cliff again. We're facing a debt ceiling debate next year, and the composition of Congress could potentially change the path for that.
I can just say, Danny, I just hear Steve Eisman's voice in my head. Oy, the deficit, oy, the deficit. They've been wrong every time. I mean, at what point do you hear this increasingly from more people?
Maybe it is bond auctions. To your point, make bond auctions great again. Maybe when we actually see some bigger tails, something that looks like a failed auction, maybe then we start having to pay attention. But in the meantime, you can say, we just need to see the makeup of Congress. We need to see what they'll actually propose, and we can ignore it for now.
I love it. So just to give you a sense, we've got a 20-year auction coming next week. We also have a 30-year tips auction coming next week. Otherwise, we've got to wait a while for those other bigger auctions. Coming up next, Katerina Simonetti of Morgan Stanley, Wendy Schiller of Brown University, Ambassador John Bolton on Iran, and Winnie Caesar of Credit Sites. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And And you were the first woman, as I understand it, first woman to own three major, have stake in three major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be
We're
important.
going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The Fed has a real opportunity here to sort of shift the narrative.
What my read of the current data is that there's enough good going on to offset whatever the weakness is.
Unemployment could really accelerate higher if you're not careful.
There's scope to go more aggressively right now, just given the combination of data that we're seeing on inflation and also on the employment questions that lie ahead.
We're hearing all these cut talks, and it's overly optimistic, looking for 50 basis points per meeting through the end of the year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Fear and volatility melting into sunshine and roses. Welcome back. Good morning. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. John returns on Monday. Today marks the transition point from earnings and data to the Fed and politics. Let's go to the Fed first. We've got Jackson Hole coming up next a week, which might be a time for them to indicate some sort of shift in policy. And then, Dana, honestly, we get the data that is going to be so important. Danny, how much are you looking to Jackson Hole versus the jobs report versus CPI?
Well, I think jobs report probably the most important, just given what happened last time. But in the meantime, you have this 2-week period that's still kind of summary, that you don't have a lot of data, and instead you have Jackson Hole. So that fills the void of the thing that could act as a catalyst. For what, I'm not certain. If anything, it seems like Fed officials are coalescing around this idea that, to Bill Dudley's point in his op-ed this morning, that they want to be preemptive, that the risks have shifted, and the greater risk is going not soon enough versus cutting too soon.
How different a couple years makes. The Payne speech really sort of resounding through a lot of economists' minds still to this point, and we haven't seen that kind of pain. But Danny, to that point of preemptiveness, that is the challenge in markets that are welcoming the sunshine and roses. of both a resilient economy and also a Federal Reserve that could cut by almost 100 basis points still as baked into markets.
And that's why you can get something that would be unimaginable a year ago, 2-year yields climbing 13 basis points and small cap stocks rallying. And they continue to rally this morning. And that is something you usually would say, okay, the bond market is backing off of cuts. Surely that has to be bad for small caps. But to your point, we're pricing in just this very thin needle being threaded, this idea that we get rate cuts, but it's an environment where economic growth is still holding up.
And it really shifts also to the political front. And I have to say, Noel Dixon was great in talking about why it matters so much, and maybe not to the stock market as much as to the bond market, when suddenly all the proposals that we're hearing about the economy include more spending or tax cuts, not necessarily fiscal discipline.
Not fiscal discipline from either side of the aisle. And we're going to get a lot of that today when we get Kamala Harris speaking in North Carolina, a swing state. She's going to talk about, you know, those Americans that you continuously see in the polls and say, I can't get on the housing ladder. Yesterday was about inflation and grocery bills. Today is about housing. $25,000 is their proposal. Biden already pitched this, but it can't be done unless you get Congress on board. But what's interesting is this comes after we got data yesterday. Confidence among U.S. home builders slipped 4th straight month. This is the idea that we also heard from Home Depot, this deferral mindset that you see consumers and Americans in because they are waiting for the Fed to cut interest rates.
At the same time, for markets, there's sort of this question of how much politics matter. And you hear different things from different people. It shouldn't matter, it won't matter, and then they say it's the first question that every client asks them about. I just wonder, you know, Danny, we're actually going to see that volatility. We have seen that volatility, what it would take to really spur some of these auction issues or some sort of real sense that maybe this time is different.
I think you can look at, again, under 4% 10-year yield and be a bit confused by it. Be confused because the data, it's not heading off of a cliff, and we have this huge fiscal spend likely to come from whoever is the president. As for what it takes, so far we've been taught that you can keep buying at auctions, you can keep loading up on duration, and everything will be okay. So we have that Pavlovian urge to keep buying it, and nothing is telling us else. But maybe you need something like last auction we saw where under 4% wasn't appealing. You have that plus deficit, and maybe that's what makes things go right. It's just like trying to find this weird mix and hoping someone pays attention.
Well, right now, if I'm paying attention, it's 3.87% on the 10-year yield, not north of 4% once again, even though Noel Dixon was talking about a potential 5% threshold that would entice him to buy. You're actually seeing yields lower today after yesterday's data, as well as just this general feeling that the Federal Reserve can keep cutting rates. The S&P looks like it is going to have a hard time eking out a 7th day of gains after the biggest 6-day rally going back to 2022. We're looking at 55.63. We are just about 2% away from record highs on the S&P. Right now, what you are seeing in the currency space is quite interesting. A real question about whether the dollar can strengthen on the heels of what is expected to be a weakening cycle, even with a resilient economy, or whether we're going to see ongoing dollar weakness akin to what we saw in the past week and a half. Coming up this hour, Caterina Simonetti of Morgan Stanley with stocks on course for their strongest week of the year. Ambassador John Bolton as tensions simmer in the Middle East, and Winnie Caesar of Credit Suisse amid signs of a resilient consumer. Let's begin with our top story, the S&P 500 looking for a 7th day of gains following strong U.S. data. Morgan Stanley's Caterina Simonetti writing this: the Fed might be behind the curve, and it is not priced into current equity multiples. While the data will determine the ultimate direction of the policy and the markets, the soft landing is still the most likely scenario. Caterina joins us now. Caterina, do you think that there is a tension right now between what bond markets and stock markets are telling us?
Well, absolutely. And when we look at in the large scheme of things at what this year has been like, you know, we went from being solely focused on Fed and rates and inflation, and now it's all about the earnings and the economic slowdown and volatility. And it's very confusing for investors, and who tend to be to have sometimes, you know, a bit of a short-term memory, because if anything, last couple of weeks showed us just how volatile stock market can be going into this pre-election stretch. You know, and this is where, of course, you know, we have to pay attention to earnings, data, forward-looking outlook, and making sure that our portfolios appropriately reflect in our views.
Katerina, almost 90% of companies in the S&P 500 have already reported earnings. We're really quite through that period of time. We have to wait until the beginning of September to truly start getting data again on the economic front. Given that a lot of the information is in front of us, and we have already, to really analyze, how do you recommend playing some of the volatility that could come up?
Well, Lisa, it is very clear that, both consumer behavior and corporate earnings are affected by this high interest rate environment. And, inflation, while we are thrilled to see the CPI data come down, we know that this is also something that will, pretty drastically affect the pricing power for the companies. So while we look at the earnings data that is in front of us, that looks to be quite positive, as we look ahead at the second part of the year, we're not quite as optimistic. We're expecting a slowdown. And while we do believe that the soft landing is the most likely outcome, it is also, something that, that coincides with expectations for the rate cuts. And this is where, Federal Reserve has a big decision in front of them on timing and, of course, the extent of the cuts.
Concerns about margins, Katerina, usually that's been used in the context about consumer-facing companies. If a consumer that we're increasingly learning is not falling apart, but certainly feels stretched. How does that work with staples? Staples being this kind of sector that you want to buy because it's acyclical, but at the same time, these consumer companies may be feeling the pain for margins.
Well, absolutely. That is a very big part of this equation, but we also have to look at it, in the context of this defensive play. What really changed the rules a bit, is this disproportional presence of the big tech exposure in most of the portfolios. And what we tell our clients is that they have to look at the consumer staples, at defensive plays, and, make sure that they have appropriate presence in, the areas of the market like the financials and healthcare and industrials. And despite of the margins and despite of the higher expenses, the area that we think will be most affected by it is consumer discretionary, which we currently have the underweight rating on, because we think that there are going to be parts of the economy that will be affected by these higher expenses and, by this environment more than others.
If we made a lot of noise about tech being overly expensive, Katerina, I wonder if it makes sense to talk about safety stocks being too expensive. Walmart trades at a 28 times price to earnings. That's more than Meta. That is more than Amazon. Is the price to safety, does it matter at this moment? Or in downturns, do you stop caring about valuations?
We never should stop caring about valuations. You make an excellent point, that we have to look at the broad context. And that's why the balance in the portfolios make all this, is probably one of the most important aspects. We want to make sure that we don't lose track of the exposure we have in one area versus another. And this is the time, precisely because of these factors, that we favor individual stock picking versus the broad index investing. Because, one company might be overvaluated, another one might be better positioned competitively in terms of the pricing power advantage, just forward-looking outlook. So this is where, we might be looking at two very similar companies in favor of one versus another.
Katerina, I want to ask you about something you put in your note about the volatility surrounding elections. Historically, it's September, October, then it dissipates in November. But this is very unconventional, this election cycle. How are you thinking about that volatility, given the fact that we've already seen a number of twists and turns in the election cycle, and it's only August?
Of course. I mean, it seems like it started so much earlier. And even though this election seems to be, just so emotionally charged, if we look back historically, going into the election, generally we can expect the heightened volatility. So what we tell our clients is just to go into it with full expectations, be ready to buy on dips, just kind of, take a note of the policies that might be brought forward by each of the candidates, not to make any drastic portfolio changes. We think that it doesn't make sense to do it prior to knowing the outcome. But we think that it is time to definitely position ourselves for what next 4 years would be like once we know the outcome.
Has this been top of mind for your clients? Is the first question they ask you about?
Absolutely. This is the most phone calls that we get is about, the outlook next couple of months, but also portfolio positioning going forward, and how do we come out of the last couple of years where the growth was so disproportionately located in certain sectors. And when we look at weeks like today, where we have this, wonderful earnings and, market seems to be recovering and investors are getting a little bit of a relief after the correction we saw a few weeks ago, this is the opportunity to rebalance. This is the opportunity to take profits and to go into some of these defensive, maybe underrepresented sectors, that should be well balanced and present in portfolios.
I love it. So many people come on and they say, you know what? Politics, they don't really matter. Do clients ever ask you? It's always the first question they ask you. Caterina Simonetti of Morgan Stanley, thank you so much for being with us. I will just say that earlier this morning, we heard again from Austin Goolsbee on NPR talking about how the economy is strong, and yet if you see employment turn, it can turn very quickly. And it really goes to this question, Danny, of whether the Fed should act preemptively that Bill Dudley put out there this morning in a Bloomberg opinion piece.
Right, because employment, it's like the volleyball held underwater that once you let go, it kind of shoots up higher. But one of the issues is people keep looking at all these different signals of recession, saying they need to act preemptively because we see things like labor market weakness. We see things like the SOM roll being triggered, like the yield curve starting to uninvert, and therefore the Fed needs to act. Part of the problem is, and Sumaya Keynes of the FT gets into this in a column, and I think it's a really good point, there have only been 9 recessions since the 1990s. That's not enough data to have statistical significance in what usually happens into a recession. So we're using all these past indicators, but I think we can say this time might be different because it's always different. We haven't had enough data to really understand what these signals mean.
Which is essentially what Claudia Sahm is saying, to say her particular eponymous rule is important to consider, but not actually a rule. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yaira Hackes. Yaira.
Hi, Lisa. Israel has begun talks with international mediators in Doha about a proposed pause to the war in Gaza. Qatar is hosting delegations from Israel, Egypt, and the U.S. to work on a 3-stage proposal. It aims to halt the fighting, free hostages held by Hamas in exchange for Palestinian prisoners, and transfer more aid to the ravaged Gaza Strip. Hamas representatives are not joining the talks. A new financial disclosure from Donald Trump shows $513 million in income from his U.S. resort and residential properties. That includes his well-known Mar-a-Lago and Bedminster clubs. The filings also reveal tens of millions of dollars of liabilities and debts linked to his legal troubles. Separately, Trump has raised about $635 million since launching his presidential campaign. And Hurricane Ernesto has escalated to a Category 2 storm as it heads to Bermuda. It's expected to become an even stronger Category 3 hurricane by this afternoon. The track currently shows Ernesto passing to the west of the island, but it could unleash heavy rain and flash floods on the territory and cause power outages. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the inflation blame game.
Harris has just declared that tackling inflation will be a day one priority for her. It's going to be day one. But day one, really, for Kamala was 3.5 years ago. Where has she been? And why hasn't she done it?
That's coming up next. This is Bloomberg Surveillance.
Could face big
bigger challenge.
Wilson's next.
It was going to keep reading World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We got the data, we got the sense of what's going on with companies, and it is all sunshine and roses, at least for markets over the past 6 days, which has been the biggest 6-day rally going back to November 2022, struggling to make it a day 7 with about a decline of 0.1%, and we're looking right now at yields, though, lower, and this is the interesting point. Even though stocks are quiet, bond yields continue to decline, even on the heels of a sign of a resilient U.S. economy. Under surveillance this morning, the inflation blame game.
If she wins, your finances and your country will never recover. You're never going to recover. A radical left person wants to put price controls all over the place, which will end up driving up your prices, not down your prices. Harris has just declared that tackling inflation will be a day 1 priority for her. It's going to be day 1. But day 1 really for Kamala was 3.5 years ago. Where has she been? And why hasn't she done it?
Here's the latest. Donald Trump returning to Pennsylvania this weekend as he aims to regain ground in the presidential race. Trump's allies reportedly urging him to emphasize policy issues and hit the Harris campaign on the economy. The latest polling from Real Clear Politics shows Harris holding a 1-point lead ahead of next week's Democratic National Convention. Joining us now, I'm so pleased to say, is Wendy Schiller of the Taubman Center at Brown University. Wendy, great to see you. It's been too long. I want to start with what we've seen out of both proposals. Do we have a sense of what the Trump economic proposal actually looks like?
Well, Lisa, I mean, Trump was president of the United States and presided over an economy that was doing well until the COVID pandemic. So in some ways, Trump has less pressure to, sort of really delineate what he will do next, since voters, right now seem to fondly recall the state of the economy under his presidency. The pressure really is on Kamala Harris. And, even though I had heard that she wanted to impose price controls, that was new to me, that other line about where has she been for the last couple of years is going to be effective, because that is a very big concern to consumers right now. And if she's taking the Biden mantle, she has to take inflation with it.
Well, she's taking inflation with it, and she's trying to put the blame somewhere else, Wendy. I think that was the whole point of the price controls. It's not us. It's the corporation's fault. She's also going to come out today and talk about housing, $25,000 for first-time home buyers. President Joe Biden also talked about this in his State of the Union. Will that land with voters, even though she cannot unilaterally do that? She needs Congress support.
Yeah, Anne Marie, I think that's a pretty out there proposal on the part of the campaign, and I don't think it helps them with independent voters. So it's really this balance, and the reason is because I think a lot of people have mortgages, have already bought houses, and that those are a lot of suburban voters that they need. This is the constant balance for the Democrats, balancing getting their base out, young people who say they can't afford to buy a home, tackling student loan debt, and also making sure to bring those independent voters back into the Democratic fold, at least in public opinion surveying. And that's the balance. And I don't think that proposal will do anything with independent voters.
She also has to balance how much she campaigns with Joe Biden, given the fact that Americans blame him for what they perceive as higher inflation. We do know the rate has come down. How does she do that?
Well, Anne Marie, in 2020, a friend of mine said this is, good grandpa versus bad grandpa, depending on, who you liked and who you didn't like. So I don't see the great liability in, showing up with him once in a while, particularly in places where he's still popular. I think it says I'm respecting Joe Biden to the base that, that still liked Joe Biden. But you're right. I don't think that it should be the most frequent part of her appearances with the campaign. But there is still a slice of the Democratic base that likes Joe Biden and believes in Joe Biden. So I still think it's a plus for them to keep doing it just for a little while longer.
And Wendy, so you described just there with Anne Marie, her housing policy is out there. I actually wonder what you think of the nuts and bolts in it and the impact would be to have 3 million new housing units, to try to encourage that through tax incentives, and giving $25,000 to first-time home buyers, about 1.4 million people. If she was able to pass that, I just wonder what you think the economic impact of such a policy would be.
Well, unless you find a place to cut, it's going to continue to blow a hole in the deficit. And, as we know, as the deficit grows, our public debt grows. So, this is something she'll have to explain. And independent voters do not want to see a major explosion of the debt or an expansion of the federal government spending. So this is really a problem. How are you going to pay for it? And that is a big question. And saying you're going to raise taxes on the wealthy or raise taxes on corporations, that doesn't usually work all that well for Democrats. So they may have to rethink how, walking that back. It's also the case that, not everybody wants housing in their backyard. We've seen that even in liberal blue states, a lot of NIMBYism. So you may want to build all that new housing, but where is it going to go and how effective can you really be?
You say the voters might start to get concerned about the deficit. Wendy, for now, the markets are not concerned. Should they become, does this market have the ability to impact fiscal policy? Could rising bond yields make a Harris, a Trump, you name it, administration change their minds in some of the spending plans?
I think this is a turnout enthusiasm game from now until November. So, your very core base of the party has to get out the door. And I don't think that slice, either the Republicans or the Democrats, is going to, base their voting decision on the deficit. So I don't see a lot of impact there. And let's remember that, Congress is full of a lot of people who like to bring home money to their districts. So tackling the deficit is always a multidimensional and complex problem with lots of other political actors who don't really want to go back and say, yeah, I cut your spending.
There was a time when one party, traditionally the Republican Party, was thought of as the more business-friendly party. And I'm just wondering, as we're talking about the deficit expanding and some sort of more populist types of policies that are coming out of both parties, I'm wondering, with the economic plans that we're hearing, do you hear one party catering to business more than another?
Well, Lisa, as you all well know and talk about all the time, the economy and business is so globally intertwined now, so different from even when Bill Clinton ran in 1992, it's the economy, stupid. That was his big slogan. Now it's a very different ballgame to think about policies that will benefit corporations or benefit workers or consumers because it's so globally interdependent. And so that, to me, is, the problem with being, corporate friendly. Donald Trump wanting to slap lots of tariffs on things may help some industries, but of course hurt other industries that rely on exports. So, and the Democrats, raising taxes on corporations, how do you do that without, producing layoffs? Corporations will say we can't afford it. So I think the complexity of the global economy makes it very difficult for parties to have a uniform or consistent message on this point.
Wendy Schiller of Brown University, wonderful insight as always, really appreciate it. Thanks so much, Wendy. I've got to say, the idea of what kind of economic proposals we're actually hearing is hard enough to pin down, let alone what the potential consequences might be.
Also, by design, if you look at a lot of the reporting, what the Harris campaign is trying to do is have these broad ideas, these ideas of opportunity and change, get the excitement of the base, but very skim on the details.
At the same time, it seems like that's the reason why stock markets aren't sure how to handle all of this. Bond markets are sure, which is that essentially there is a lot of spending and not a lot of cost cutting. The U.S. Treasury spent $861 billion on net interest in the national debt over the 12 months through the July, double 2 years earlier. And it would be $100 billion more if you added in some Fed interest payments, and it's set to double yet again. You wonder when this starts to get some more attention.
And perhaps it is if we have an election and you do have both a Democrat in the Oval Office and a unified Democrat Congress. Maybe that's when we start to get worried and say these proposals may be thin on details, but maybe they can actually get passed.
They get worried when the 10-year auction comes in and it's very disruptive and there isn't necessarily the base of primary dealers to take it down and cushion it all. But, you know, maybe I'm biased. Coming up next, former U.S. Ambassador to the United Nations, John Bolton, on tensions in the Middle East. Right now, markets struggling to eke out a seventh day of gains, but things can change. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What a wild ride. Just to put this into perspective, we just had the biggest 6-day winning streak going back to November 2022 after the biggest spike in volatility since the height of the pandemic. Right now, welcome back. This is Bloomberg Surveillance. We are struggling to really eke out a 7th straight day of gains, a mild kind of pause as we see S&P futures lower by about 0.1%, still about 2% away from all-time highs reached last month, 55.60. NASDAQ also meandering, but still that outperformance, Danny, it's squarely on the Russell 2000, up 0.2%, even with this idea that the economy is resilient and maybe on the margins it could pressure the Fed to cut less.
Right. Goldilocks, potentially, I'll say her name out loud, Goldilocks, potentially, because you do have maybe not as big of Fed cuts as we wanted, but some semblance and an economy that's doing well. But I still go back to what Lisa Shallett said yesterday, that there are some companies that are not good in the Russell 2000. So how many people here are trying to make a macro play or just buying up the index level without realizing that the quality of companies in the Russell 2000 has been declining year over year as private equity hoovers up a lot of the good lasting ones?
In the meantime, this really does come down to what happens with the Fed. They allow this kind of cycle to continue. And we did get this piece from Bill Dudley, former New York Fed president, out, which is really interesting. Right now we're seeing in the bond market yields continuing to be quiet, heading downward after yesterday, rising in the 2-year up some 13 to 16 basis points, actually at the biggest potential sell-off, with yields spiking, now down about 5 basis points, 4.04%. 10-year yields also lower a similar amount, 30-year yields also lower. But yesterday we saw this surge because of a resilient economy at the same time that you're still hearing Austin Goolsbee talking, Anne-Marie, about the idea that they want to get ahead of any kind of downturn. That is exactly what Bill Dudley is talking about. At Jackson Hole, will we hear this Federal Reserve shift to have a more preemptive policy stance?
Potentially, if the Fed is ready to cut in September, Jackson Hole is the moment for Jay Powell to really insinuate that. Ed Yardeni, who'll be coming up with us a little bit later, talked about the fact that he thinks the Fed needs to go one and done. And he says the debate now is not September, November, December. It's 25 basis points or 50 basis points.
And the question will be, what does this mean for the foreign exchange currency transmission mechanism? A lot of people are saying this would mean weaker dollar, which is the reason why people were bailing out of the weak yen carry trade. They appear to be going back into it, which has been something that people are talking about in terms of maybe you do see a dollar continuing to strengthen on robust growth. Today it is not cooperating. So that is seeing a bit of a decline, 148 on the dollar-yen cross. Under surveillance this morning, Vice President Kamala Harris will propose offering $25,000 to first-time homeowners as part of her economic policy rollout today. More than 1 million home buyers who have a 2-year history of on-time rent payments would be eligible for the benefit. A real question here about the feasibility of this getting passed, Anne-Marie.
Well, she needs congressional support to get this passed. And Wendy Schiller was just talking about how basically this is an economic pipe dream at the moment. But it does play to the concerns you were seeing with voters, not just higher grocery prices, which they discussed yesterday with this idea that the blame is not us or just the economics of the time coming out of the pandemic. It's actually price gouging from corporations, a ton of pushback on that. But the fact of the matter is, when you look at the inflation report yesterday, what was that biggest component? It was housing. Inflation rates are high right now. I mean, mortgage rates are high right now. So they're trying to tap into that. But again, I think it's going to be very slim on the details.
What do you think happens to prices if you give people more money to spend on them? I'm just saying. Meanwhile, talking about price gouging, Kroger planning to lower grocery prices by $1 billion if its merger with Albertson materializes in a bid to appease the regulators. That doubles the company's previous commitment of $500 million in cuts at Albertsons locations. On one hand, Danny, you have the question about antitrust and pushback. On the other, you have a question about just how high inflation actually has or has not been within the food space. A report coming out on Wednesday showing that grocery prices in July were up only 1% from a year earlier.
So there's this really funny conversation happening online that I see basically on every social media channel right now where people are saying, oh, my grocery bills have doubled. And people have said, no, they're not. What are you talking about? They have not doubled. They are slowly growing. But it goes to the point of this is so high in the voters' minds. You have proposals for Kamala Harris to stop price gouging. If that's the case, can we realistically think that Kamala Harris and Alina Khan FTC is going to let this merger go through? Even if they're proposing that they'll slash $1 billion in costs, it's so difficult to track. They have so many different branches, so many different products that it's hard to kind of keep grocery stores honest on pledges like this.
Well, yeah, and it's very difficult to know exactly what the rhetoric is going to be now versus the actual policy, considering the fact that potentially it might be more amenable. I will just say this is the reason why you've had just sort of frozen M&A markets with a lot of companies real skeptical of really spending real money on a deal that may or may not transpire. Meanwhile, Gaza peace talks underway in the Middle East between Israel and international mediators. Axios reporting some progress was made on the first day of discussions, citing U.S. officials. This coming as Israel braces for a possible attack from Iran. Joining us now is Ambassador John Bolton, former U.S. National Security Advisor and former ambassador to the UN. Ambassador Bolton, thank you so much for being with us. I want to start with what you think of the recent talks underway and why you think Iran has not retaliated yet.
Well, with respect to the talks, the administration saying making progress, they've been saying making progress on these talks for about 4 or 5 months now. They never seem to get to the finish line. I think there are still enormous gaps between the Israeli position and the Hamas position. I'm not saying a miracle couldn't happen. It happens in the Middle East from time to time, but I wouldn't look for it. I do think Iran has hesitated to retaliate for the killing of Ismail Haniyeh, the Hamas leader in Tehran. They need to strike back, I think, very strongly. They've been humiliated by what Israel did, killing this terrorist leader in their capital, in a secure compound, with a bomb planted 2 months before. It shows nobody in Iran is safe from Israel, including the supreme leader. On the other hand, the Iranian leaders are also intimidated by Bibi Netanyahu and Israel. I think this time they are worried that the U.S. will not be able to pressure Israel into a limited response, as Israel did after the 320 drone and missile assault on Israel from Iran's territory some months ago. Really, Iran is more intimidated by Israel than it is by the Biden administration. So they've got a difficult decision, how strong a response to make to restore their own very damaged credibility versus their fear of what Israel would then do to them.
Well, in April, when those 300 missiles were flying over, it was because of the U.S. defense that Israel's able to fend them off. And Ambassador, given your level of intel regarding Iran, how can they retaliate but also try to not strike this cycle of endless retaliations back and forth?
Well, let's come back to the April attack. Wall Street Journal and CBS reported that of the 120 ballistic missiles that Iran fired at Israel, 60 never made it within range to be shot down. They either blew up on the launch pad or crashed before they got close enough, which speaks to the quality of Iran's ballistic missile force. But if there had been 120 rather than 60 ballistic missiles in the skies over Israel, I don't think it would have been such a good performance. The cycle that's at work here is caused by Iran. Look, this is not a war between Palestinians or Gazans and Israel. This is a war by Iran against Israel, what they themselves call the Ring of Fire strategy. And as long as the current regime in Tehran is in power, seeking nuclear weapons, arming, equipping, training, financing, giving intelligence to multiple terrorist groups in the region, threatening not only Israel but the Gulf Arab states too, there's going to be conflict. And what's driving Israel and the Gulf Arabs closer together is they all see Iran as the main strategic threat, and they think the United States is feckless.
As these ceasefire talks continue, do you agree with the idea that Iran could potentially use those, if they were to ink a deal, use that as an off-ramp to not retaliate?
Well, they may want to use it as an off-ramp, but I think it would be a big blow to Iran's prestige. You know, they're not exactly stepping up here to take responsibility for what happened to Hamas after the October 7 attack. And they've also not been able yet to persuade Hezbollah to use its unbelievably large arsenal of missiles against Israel. So, as I say, I think it's the fear of further Israeli retaliation that has the Iranians intimidated.
With that retaliation coming from Israel, if Iran does do some sort of large attack, Ambassador Bolton, what is the ability of the U.S. and its allies to rein in Netanyahu's response?
Well, I'm sure that the Biden administration will want to rein them in. They've been afraid of this issue and the war in Ukraine dominating the news in the United States because it shows a world in chaos due to 3.5 years of American weakness. Really, what they would like to see is this go away until after Election Day, even though Biden's no longer running himself. You know, frankly, I think the lesson to be learned is that the prospect of a really forceful Israeli response, if Israel comes back at them, shows that a strong posture toward these rogue states is the way to go. And Iran has a lot to fear from Israel. It should have a lot to fear from the United States, but at the moment it doesn't.
And Ambassador, a lot of times when we're talking about this retaliation, even if Iran would like to do that without provoking a response, the question always comes into the fore, what is the likelihood that mistakes are made? Mistakes are made that escalate things further. And that there's been this conversation that it won't just be Iran this time, but Hezbollah as well. Are the odds for mistakes higher by involving proxy forces in the retaliation to the retaliation to the retaliation?
Well, look, I think you have to look at what the strategic picture is. There is a regional war in the Middle East now of Iran against Israel on 5 fronts. Hezbollah from Lebanon, Hamas in the Gaza Strip, the Houthis that have closed the Suez Canal, Red Sea passage, one of the most important commercial shipping channels in the world, closed effectively since October. The Shia militia in Iraq and Syria that have been attacking American positions, and Iran itself. And the question is, how do they dial up one or the other? Israel does fear Hezbollah's arsenal, which in public estimates, this is an extraordinary number, but public estimates are that Hezbollah has between 120 and 150,000 missiles, which would obviously be enough to overwhelm Israel's air defenses, and leads to the question, if they really think it's about to happen, might not Israel strike first? It's complicated. It's not mistakes. It's the fact that the leadership in Tehran is determined to destroy the little Satan. That's what's at work here.
Ambassador Bolton, yesterday we heard from former President Donald Trump, who you worked for. He said, I'm not looking to be bad to Iran. We're going to be friendly, I hope, with Iran. Maybe, but maybe not. But we're going to be friendly, I hope. We're going to be friendly. Do you know what Trump 2.0's policy towards Iran potentially will look like?
Look, he has no idea what it will look like. People who look at what happened in the first term and believe that it'll be the same in the second term, I think are mistaken. It's always possible, but remember, Trump almost met with Iran's then Foreign Minister Javad Zarif at the Biarritz G7 summit in August of 2019. Emmanuel Macron, the president of France, had Zarif in a villa in Biarritz, almost persuaded Trump to do it. The attraction to Donald Trump of making a deal with anybody is hard to quantify. It really goes off the charts, and it could be the same way in a second term, and that's why I think there's a certain amount of pressure on the Israelis, if they're going to do something, to do it now rather than to wait for the uncertainty of the American election.
Ambassador John Bolton, thank you so much for taking the time with us today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hawkins. Yahaira.
Hi, Lisa. Bayer shares are rising after the German company scored a legal win surrounding its Roundup weed killer. A customer had sued over the product's warning label, arguing it should have warned about cancer risks, though Bayer has insisted the product is safe. An appeals court found that case supersedes state law and needs further legal review. The ruling is a much-needed win for the company, which has seen shares fall 49% in the past year and more than 70% since acquiring Monsanto in 2018. Meanwhile, Texas Instruments will become the latest U.S. tech company to get a boost from the Biden administration. The chip maker is set to receive $1.6 billion in CHIPS Act grants and $3 billion in loans. The funding will help pay for one semiconductor factory in Utah and 2 in Texas, which will be built through the end of the decade. U.S. officials have now allocated most of the CHIP Act's funding with more than a dozen awards. They expect to wrap up announcements by the end of this year. And Citibank is being accused of failing to properly compensate its bankers for meal breaks, rest breaks, and pre-shift work. A proposed class and collective case accuses the company of violating the Federal Fair Labor Standards Act, as well as the labor laws of at least 48 U.S. states and Washington, D.C. The bankers brought their case in the U.S. District Court for the Southern District of New York and are seeking unpaid wages and punitive damages. According to the complaint, Citibank began failing to pay the bankers for all hours worked as early as 2018. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the resilient consumer.
Coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient, and it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative.
That's coming up next. If you don't have a clear sense from the ping pong we've been playing, don't worry, it'll probably change by next week. This is Bloomberg Surveillance.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Remember that stress of last week? Yeah, neither do I. Right now, you're seeing pretty much a calm in markets after the biggest six-day rally going back to 2022, declining about 0.1%. What I find interesting is that yields continue to go lower, even with the prospect of a resilient U.S. economy. The idea of preemptive Federal Reserve rate cuts coming squarely into focus. 10-year yields 3.87%, down about 5 basis points. This all comes down to how much Americans are buying. Under surveillance this morning, the resilient consumer.
Coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient. And it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative. So we've seen a massive shift from focus on inflation to focus on the economy. And I think that's where sort of every data point seems to matter to the market.
And whipsawed in turn. Here's the latest. Traders paring back bets for a supersized September rate cut, now expecting fewer than 100 points of easing this year after stronger than expected retail sales and jobless claims data. Winnie Caesar of Credit Sites writing this: we are encouraged to see the repricing of Fed cutting expectations as the jumbo cuts priced in immediately after the July jobs report were far overdone. Winnie joins us now. Winnie, before getting into just sort of the details of just how many cuts and when they're going to cut and a supersized jumbo cut, I'm just wondering whether you endorse this idea of a preemptive rate cutting cycle that can stave off weakness that currently is nowhere in the pricing in frankly, credit or in stocks.
Good morning, Lisa. Well, we have been saying that the Fed should try to be more proactive in this rate cutting cycle. It was something that they tried to do in 2019 with some, quote, insurance rate cuts to continue the expansion in the economy. And we did hear Fed Chair Powell discuss that topic pretty explicitly at the last Fed meeting. But there is much stickier inflation in the pipeline in this cycle than there has been in recent memory. And so that does leave the Fed in a pretty challenging position. But we do think that some proactive rate cuts probably make sense at this point.
This makes a really important difference for particularly high-yield credit, because these are the companies that are most akin to the Russell 2000 in credit land, and they're the companies that have more leverage and have higher yields and are going to be more susceptible to both a weaker economy as well as potentially borrowing costs going down. So how do you see sort of the success of the Fed's ability to preempt some kind of weakness? How do you see how it's being priced in markets and whether that reflects reality?
Well, right now within the corporate credit markets, there's a pretty significant dispersion across valuations. You have pretty tight spreads and I would say objectively good yields for a lot of the double B and single B universe. And then on the other side, you have the triple C world, which is trading kind of near distressed territory in aggregate, still a wide range of valuations there. So investors are definitely taking a close look at these more leveraged capital structures that have higher vulnerability to sort of economic deceleration amid elevated borrowing costs and saying, you know, these are probably not sustainable over the long term, which means we think that there is going to be a default rate that is, you know, above the pandemic lows for maybe an extended amount of time as some of those defaults work through the system. But it doesn't mean high yield in aggregate is a necessarily bad place to be right now.
Winnie, there is this criticism that part of the reason you don't see some of those risks reflected as much as they should is just because of an imbalance. There's just so much demand right now compared to what supply is, and then private credit, the argument goes, is also distorting thing. Is risk distorted at this moment?
I would say that risk is not necessarily distorted, but technicals have been absolutely driving valuations. And that is just the supply and demand balance. Right now, with fixed income yields at 5% for investment grade, 7.5% for high yield, those are historically very attractive places to get involved in corporate credit. And that is pushing a lot of capital into fixed income and into credit. And at the same time, fundamentals have been good enough for credit. We have definitely seen some erosion, some deterioration as it relates to leverage coming down, interest coverage coming down. But in general, you know, the numbers are still okay. No one is expecting this massive downgrade cycle. And so people are kind of balancing that and seeing the technicals being so strong, feeling a little bit okay with where spreads are.
So that's the demand side of it, Winnie, and why that remains strong. As to supply, what we have seen, most of it has been refinancing. What level of Fed cuts do you need to see to really reawaken deal activity?
Well, it's been interesting because we've seen a lot of deal activity this year, but as you've noted, the bulk of it has gone to refinancing. I think there are a number of other factors weighing on the broader M&A and LBO environment outside of just the interest rate side of things. I think that if we had more certainty around what the regulatory environment was going to look like in the next political regime, what the actual economic outlook was, you know, do we have a true consumer deceleration? Is growth going to slow down significantly, or are we going to stay at 2% GDP? And also some relief on the borrowing cost side of things, then I think that a lot of companies would be a little bit more willing to pursue some pretty transformative acquisitions. But we're just not in that place right now with the uncertainty around regulatory, the economy, and also borrowing costs.
This is kind of, I guess, a difficult question, Winnie, but when we talk about easing financial conditions and easing monetary policy, hasn't it effectively already been eased for a lot of these companies? In other words, if the Fed cuts by 100 basis points, let's say, even that much, will that actually change the backdrop for companies that are already enjoying rates that price that in proactively?
So this is an interesting nuance within the financial conditions conversation. Borrowing costs are still elevated across the world of corporate credit. When we see new issue deals priced in investment grade or high yield, they're pricing at coupon levels that we haven't seen, you know, in a decade, given how low yields got in the post-GFC and then COVID era. And so there has been a pretty significant repricing of the cost of debt, which I would argue is, you know, a little bit more tight financial conditions. But execution has been strong. Companies have not had to really worry about, by and large, going to market and not actually having people come and buy the debt that they're issuing. And oftentimes companies will look at that execution and the ability to have access to the capital markets as a pretty constructive sign overall. So I think that the financial conditions and easing, that conversation is a little bit more nuanced just then companies can come to market.
Which is especially the reason why also, how much will the Fed affect change by actually engaging with rate cuts versus just confirm what already has been baked into markets. Winnie Caesar of Credit Sites, thank you so much for being with us. As always, honestly, I'm looking at the Bloomberg Financial Conditions Index, and Danny, you can actually see it getting easier over time, and not tighter, which really highlights how it sort of raises this question about how effective the Fed is with actual policy versus just simply forward-looking rhetoric.
And you could even argue that the last policy decision, having Powell come out and sounding a bit more dovish than his last policy conference, was enough to kind of inject not full cuts, but some level of verbal cuts. And you also see that in mortgage rates coming down slightly enough where you have the most people coming back in for mortgage applications and sometimes surging 17%. So you can see some of the pockets of the easing starting to play out. And then you couple that with people calling for 50 basis points of cuts. What environment would that actually put us in?
Well, especially because we're already pricing that in. That is the issue. That is effectively what this market already has baked in the cake. Coming up next hour, Dale Cronk of Wells Fargo, Jen Bartashis of Bloomberg Intelligence as we look back on Walmart and some of the other retail earnings and data, Betsy Stevenson of the University of Michigan, and Ed Yardeni of Yardeni Research. This is Bloomberg Surveillance.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issues, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
aggregate profits look great, but it's really just a couple of sectors that are driving it.
Sentiment did get a little bit dented around large cap tech earnings.
Some of that negative correlation to equities is coming back.
Our view is that a soft landing backdrop is good for a broad swath of companies.
I think this is more of an unwind than a momentum flush. The low volatility period is behind us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Last week was Armageddon. This week was Goldilocks. On to next week, which will just come up in a couple days. Good morning. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. Jonathan Ferro will be back on Monday. Right now, we're looking at markets struggling to eke out a seventh day of gains. A real question now, Danny, as the focus goes not just to the data, the economic data and the earnings, but to the Federal Reserve, the symposium in Jackson Hole, and to politics.
It does, because we have this dearth of things for the next 2 weeks, so that kind of has to be it. Still in the late summer trading markets where we've learned what can happen during it. But to your point, it is a market that just keeps swinging back and forth between extremes. And really one of the most successful trade in bond markets has been to fade those extremes. Fade the 6 rates cuts priced in at the start of the year. Fade no rate cuts. Fade again the 100 basis points of cuts priced in. You just keep going back and forth.
It's a seesaw of basically fading moves, but a lack of conviction. And this really raises the issue of the volatility introduced by politics. Anne-Marie, I love that we ask people about politics. They say, we don't like to talk about politics. We don't think it matters that much. We think that probably markets trade independent, long term. And then they say it is the #1 question from all of their clients every single time they have a conversation.
Yeah, so the strategy, when you hear from some of our guests, is this is just noisy, look through it. But then it's like, oh, okay, so what are your clients asking you about? Oh, this is the #1 issue they have, and they want to prepare themselves for it. I think what's interesting about this week is because inflation, to many of the Fed speak, seems to be that they're feeling like they're getting it a little bit more under control. But inflation is the big driver for this election. And we're going to see, we have seen that through the policies that both sides are trying to come out and talk about. Paul Donovan, I loved his note this morning. The U.S. presidential election may be won or lost in the aisles of Walmart. That's how close food inflation, things like that, are going to be tracking these voters.
Well, all I know is that Walmart had just a fine time in terms of the food aisles, in terms of its stores. And I think that that's part of the issue, part of the tension, Danny, right now. Whether bonds and stocks are sending the same message, because at a certain time, bond markets are allowing for a pretty aggressive path for the Fed. At the same time, the stock markets are expecting this resilience to continue. How important is next week's discussion by the Federal Reserve, by Fed Chair Jay Powell, on the preemptive actions of a central bank that wants to avoid the traditional hard landing that happens almost every time there's a rate hiking cycle of this size?
Well, we'll make a difference to the whole debate of 25 versus 50, because presumably if you're going 50, it's because something is wrong, that you are too late and you need to catch up. If it is preemptive rather, 25 certainly makes sense on that point. But the bond market keeps overdoing this. It's like Schrodinger's recession, and the bond market thinks the cat's dead, and every time we get data and look inside the box, it's actually alive. And so the Fed maybe needs to kind of thread this and say, we're not going because we're falling off of a cliff. We are going because we're trying to prevent that.
I just have this image now of a box with a cat, and then, of course, it's Friday, and so everyone can go look at cat videos. Right now, we're looking at markets that are mildly negative, basically range-bound, trying to find direction after having the head-spinning kind of experience of the past 2 weeks. What we're seeing right now, S&P futures still about 2% away from all-time highs reached last month, 55.58 if you take a look. You've got euro strength, and this to me is actually one of the more interesting stories of the past few weeks. Have we started to see the euro breakout, or more importantly, the dollar more consistently weaken versus other currencies? DXY really seems to highlight that trend, which goes counter to what so many people said about the U.S. economy being exceptional. And 10-year yields lower today, 386. What I find curious is how much do people, as they start to talk about politics, really bring back the deficit discussion that so many people say, okay, this tired old thing, it never will come to markets until it does. Does that start to sort of percolate up a little bit more? Coming up this hour, Dale Cronk of Wells Fargo with stocks on track for their best week of the year. Former Labor Department Chief Economist Betsy Stevenson on what recent data means for the Federal Reserve. And Ed Yardeni of Yardeni Research on why he's still in the one-and-done September rate camp, an increasingly out-of-consensus call as the market prices in potentially 4 rate cuts through the end of this year. Let's begin with the top story. The Goldilocks scenario is back on the table and fully embraced. Stocks rallying on strong U.S. retail and labor data, indicating continued economic strength. Daryl Cronk of Wells Fargo remaining cautious, saying this: The U.S. economy is slowing, and the Fed should be cutting interest rates. They probably should have already cut in July. The burden of proof has now switched over in the market's eyes and is on the soft landing to prove itself. Daryl joins us now. Daryl, did you write this before this past week's data?
I did not. I actually wrote it yesterday morning. Look, I think outside of markets' kind of vicious reaction last week and this, if you kind of double click below the surface, there is disconnects here, right? The yield curve is disconnected. I think some of the consumer data is disconnected. We read, retail sales yesterday up 1%. That was, almost 6/10 of it was autos, right? The rest of it was food, beverage, which is stuff we all have to consume every day. So it wasn't like discretionary spend, right? It wasn't some big, element that showed that the consumers out there spending crazily, right, on this. And I think there's disconnect in the manufacturing data and the housing data. We got the National Association of Home Builders yesterday. Think about it this way: that came in at a 39. Right, anything below 50s, means that their outlook is poor for home builders. And yet home builder stocks are going crazy, right? I mean, they're up, setting new, basically all-time highs. So you've got all these disconnects that I think markets have to reconcile themselves with.
Let's talk about one particular disconnect in the bond market, where you have parts of the bond market talking about an economy that is in need of a lot of Fed support, and then you have other parts of the bond market that are suggesting that this is an economy that's quite robust. How do you understand and reconcile some of these discrepancies?
Well, I think you put it well earlier, right? Think about it this way. I wake up in the morning and the first thing I look at is the 2-year Treasury, right? Quickly, generally now, last couple of weeks, followed by the Japanese yen, right? Those are the two eyes-on elements. The 2-year Treasury at 4 to 4.25 does not sync with 9 interest rate cuts between now and next year, right? The math just doesn't work. I mean, the Fed funds is a 5.25. You bring it down to, let's say, 4, that's 125 basis points of cuts. We have 100 priced in for this year alone, much less what we're going to do in 2025, according to the Fed. So we're right back into this camp of who's right, who's wrong. Is the yield curve right and the 2-year Treasury right at 4 to 4.25 and maybe grinding higher? Or, are we going to get 9 interest rate cuts? We've seen this movie before. We didn't believe it at the beginning of this year on the 6 interest rate cuts, right? We said that would get walked back. We didn't believe it at the beginning of 2023 when the Fed funds futures priced in 3 interest rate cuts for the back half of 2023. Third time's a charm. There's no doubt the Fed will go in September. I just don't believe the 7 to 9. And if you get 7 to 9, it's a problem for the economy. That's the reason we're cutting that aggressively, right? It's not because we're soft landing this thing and we need 9 interest rate cuts to get back to our start.
I wonder what you make of duration and the level of the 10-year right now. We were having this discussion earlier with State Street, this idea that you're living in a time where the soft landing seems probable, at least for now. We're not falling off a cliff at the very least. This week. We'll talk again next week.
Yes.
And in the meantime, you have these policy proposals coming from candidates that seem to indicate a lot of spending. And you have fears about auctions and auctions that have tailed, yet it is a 10-year that is still below 4%. Mm-hmm. Does that make sense?
I don't think it makes sense. I do think the long-term kind of neutral rate of the 10-year is around 375 to 380, not very different from today. But just last week on the volatility, we had been, like most people, kind of crowded on the short side of the curve in our exposure and positioning. We basically took that positioning and we bulleted it, right? Not barbell. So in other words, we took money out of the long side, took money out of the short side, and went right to the belly of the curve because we think you're getting good value there. You do have to start biting in duration and take some exposure there if the Fed is going to cut interest rates, which we believe they will. We just maybe fade this idea that they're going to be able to cut as aggressively as what everybody else does. So you do have to go after some duration here. You can't just live on the short side of the curve, or you're going to get killed with reinvestment risk over the next 12 to 18 months.
Back to the fiscal policy outlook, though. Is the bond market just ignoring all these policy proposals?
For the time, yes. I mean, if you went, so if you take my neutral rate on the 10-year at 380, and then you, regardless of the candidate, right? The two things that I think are certainties post-November are, bigger federal budgets and fiscal spending and more tariffs, right? Those are the two things you can bank on, regardless of whether you get, Harris or Trump. And both of those put an upward bias into interest rates, all else equal, right? So I think you're going to see this continued, fight, these kind of 2 sigma moves in yields on a daily basis that we haven't seen in maybe careers of a lot of bond traders and people who manage money. but it may be the new norm. The volatility may now exist fully in the fixed income markets and not as much in the equity markets as we just keep the carry trade in the short vol, and we just drive the VIX down into, from 65 to 15, and we push the yen back weaker again, right? It's just, we're carrying on right now.
It sure feels like we're seeing a lot of once-in-a-career events just in the past 2 weeks. One of them being the yen, which you said you wake up in the morning and check. What does it tell you when you wake up on a day like yesterday, after the U.S. data, and you see dollar-yen up 1 1/3%? After just, again, 2 weeks ago, a week ago rather, about a week and a half, we saw this huge appreciation in the yen, that we can get that firepower back with dollar-yen.
Yeah, I think it's, last week was all about kind of vicious unwinds of the yen carry and the short vol leveraged trade, right? They're putting it right back on this week, right? I mean, and putting it on with a vengeance. And it's coming from the buyers, they're shorting the yen and they're shorting the vol or VIX, using that capital to go out and buy risk-on assets, right? And it's coming from all sources. It's coming from the hedge fund community, it's coming from institutions, it's coming from retail, it's coming from buyback programs that now we're getting to the end of Q2. Companies are using any weakness to aggressively step in with their buyback programs. So it's coming from all corners, and until you change that and you couple it with kind of August seasonal low liquidity, and it creates these outsized moves.
Let's just take a step back for a second. You said the volatility now exists fully in the bond market, almost more so than in the stock market. Has that affected the way that you position, where suddenly stocks become more of the haven trade and bonds become more of a trading game, sort of the sort of daily grind that you think of with day trading of stocks, not traditionally bonds?
Yeah, some of the worst performing returns at the asset class level were in the fixed income markets this year, right? Maybe up until about last week. But the Barclays Agg, which is your common domestic indice, is one of the few indices that still hasn't set a new all-time high. Everything else is pushing, all-time highs across the board, and the Barclays Agg has not given you much return over the last few years. People get enamored with the idea of I can now get 4, 5, 6%, on the short side of the curve, but when you actually get to a total return, it's pretty anemic and it's pretty bad. So it's pushed people to equities as kind of there is no other alternative, right, the TINA trade, and they just keep going back to that as a way to get exposure until you can't or don't, right, until volatility spikes.
Is that how you're arranging things? Are you buying into the TINA and staying away from big risk in bonds?
No, I would say we're a little more balanced. So we used last week's weakness that we bought into small caps, right, when the Russell 2 came all the way down to 2,000, had a 10% full correction. We bought into high yield because we thought, at 380, 385 on high yield spreads, that was the highest or widest spreads of the year, right, that we finally got a chance to take a bite at some high yield in that environment. And then we moved out duration on the fixed income market. So, but overall, I think from equities to fixed income, we're slightly overweight equities, but nothing where you've pushed risk budgets or positioning out to extremes at this point. And I think that'd be a mistake, to be honest, at this point.
Well, we can get into why in a bit. Daryl Cronk, always wonderful to speak with you. Thank you so much for being with us. Daryl Cronk of Wells Fargo. Right now, let's get you an update on stories elsewhere this morning. Yahaira Hackes is here with your Bloomberg Brief. Yahaira.
Hi, Lisa. Kroger is planning to slash grocery prices by $1 billion if its merger with Albertsons goes through. That's double what it previously pledged to cut at Albertsons stores. Kroger agreed to acquire its rival Albertsons back in October 2022. The nearly $25 billion merger is an effort by Kroger to compete against the likes of Amazon and Walmart. Resorts World Las Vegas has been accused of catering to individuals with ties to organized crime. The Nevada Gaming Control Board has filed a complaint alleging that the property welcomed people with suspected or even actual ties to illegal bookmaking and histories of federal felony convictions. Resort World is owned by Malaysia-based Genting Group. And Bloomberg has learned that Seagram heir Edgar Bronfman Jr. is close to making an offer for Paramount Global, setting off a potential bidding war for the entertainment company. Sources say Bronfman is weighing an offer for the controlling company of Paramount, National Amusements, as well as Paramount itself. Remember, Paramount agreed to merge with Skydance back in July, but Bronfman's group is framing its proposal as a better deal for investors because it won't include the dilution associated with the Skydance merger. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the morning calls, plus more insight into the consumer with earnings from Target and Macy's still ahead. We already got Walmart, and that was pretty much a boon for the consumer. That's coming up next. This is Bloomberg Surveillance.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The bulk of the earnings are over, although we do have a few key ones coming up. Time now for the morning calls. First up, Williams trading double, upgrading Nike to buy from sell. The analyst saying the athletic giant is on the right path after rehiring longtime executive Tom Petty to focus on retail partnerships. Next up, JP Morgan raising its price target on BJ's Wholesale to $76, keeping an underweight rating. The analyst noting that forecasts are essentially unchanged, while second quarter estimates will likely get a boost from gas profitability. And finally, Bank of America raising its price target on Walmart to $85, keeping a buy rating. The analyst highlighting strong second quarter earnings and higher margin profit streams, helping to offset some mixed sales headwinds. The big box retailer seeing its grocery and health and wellness categories outpacing other general merchandise, as Walmart lifts its full-year outlook on the back of consumer spending for necessities. Investors waiting to see what next week's retail results bring. Joining us now to talk about those retail results, as well as what we've seen so far, is Jennifer Bertashis of Bloomberg Intelligence. I guess that really the key question is going to be heading into next week with Target and some others. There's an issue of how much Walmart speaks to consumer resilience and how much Walmart is a story unto itself.
That's an excellent point. I mean, Walmart generally has its own dynamics. And when we look forward to Target next week, one of the things to keep in mind is that a year ago in second quarter is when they had the backlash from all of the boycotts that consumers had from their Pride merchandise a year ago. And so they do have easier comparisons, so that's a great setup for Target. But they still skew to more discretionary spending. And so it will be interesting to see how well they've attracted consumers in to buy more of those essentials through price reductions and advertising and things like that.
Jennifer, what do you make of whether the consumer is strong or whether the consumer is weak? You have retail sales that highlighted the fastest pace of expansion going back almost a year. At the same time, Daryl Cronk was just on talking about how the bulk of that was in auto sectors. And honestly, we are seeing a lot more pushback and desire for value. So Jennifer, where are we in this?
Well, I think across the board, the consumer is not getting worse, but they're not getting better as fast as probably most people would like. And that's really reinforcing that search for value. With regards to current spending, we are in the middle of back to school. So we are seeing consumers spending a little bit more for school supplies and things they need to get their kids back to school, back to college. But that spending could actually extend a little bit longer throughout this current quarter than most people expect, just as people buy things a little bit closer to when they need them versus stocking up ahead of time.
Jennifer, I was really interested by what Walmart CEO had to say about AI in their call. He said that they use generative AI to create or improve 850 million pieces of data in the catalog. They say without generative AI, they would have needed 100 times the workforce that they currently have to get that work done in the same amount of time. It's been easy to kind of make fun of all these missed attempts at trying to use AI for some of these consumer companies. But is Walmart onto something here? Are these companies finally finding a way to adopt AI for efficiency?
I think that this is a great example of where generative AI can be a real boon to a business. And if you think about the chase of Walmart trying to catch Amazon, it's technology like generative AI that will actually allow them to close that gap more quickly. Instead of having to hire labor and people and going through kind of that arduous process of cataloging things, AI can really unleash potential there. And so I think this is a great example where it's been used in a thoughtful manner, and it's a way that's helped them accelerate their business.
Jennifer, we do see inflation somewhat still biting some individuals, especially when you look at Home Depot, their report, where it talked about people are deferring some of these big projects. There's a lot of noise coming from Washington, this blame game. Do you see anything closely remote to price gouging right now when it comes to retailers?
Well, on the staple side, when you're talking about food and groceries, we have seen prices come down a little bit. One of the things that Walmart did talk about on their earnings call earlier this week is just that about half of their suppliers are engaging in trying to lower prices. About half are still saying they might want to pass through further small price increases. But it is a hot topic. I mean, we're hearing from the campaign trail that prices need to come down. The unfortunate thing is that it's just not as simple as that. We've got costs that carry through an entire supply chain. So I think there'll be a lot of scrutiny on the packaged food manufacturers on the staple side, and how retailers can help control those costs to make things as affordable as possible for consumers.
We're speaking with Jennifer Bertashis of Bloomberg Intelligence after getting retail sales that came in yesterday at the fastest pace in more than a year, after getting Walmart earnings that were incredibly robust relative to even expectations when you look under the line items, maybe not in the overall projections. And then when we've been speaking to one travel executive after another about how, particularly in the higher income brackets, people keep on spending. Jennifer, how much are we seeing any deterioration whatsoever in higher income bracket spending at a time where that has been one of the big drivers of overall consumer appetite, just when you look at aggregate numbers, albeit maybe not just the average rank and file household?
Well, we're not really seeing deterioration in the higher income spending. What we're seeing instead is a slight shift in where and how they're spending. And so I think they're being more thoughtful about their expenditures, but that's not necessarily changing the full amount that they're spending. And so we still see people prioritizing travel. We still see people prioritizing things that are experiential in nature. Those things, we think are going to continue. And that should, add a little bit of, resiliency to the overall consumer spending. But we're really not seeing much of a pullback on the high income side.
Jennifer Bertashis of Bloomberg Intelligence, thank you. And that sounds consistent with what we heard from the likes of cruise liners as well as luxury resorts and hotels. I have to say, this really is going to be one of the key challenges for the Federal Reserve next week at Jackson Hole. How do you deal with the fact that you've got lower income consumers that are highly stretched, that are really feeling the effects of high rates, at the same time that overall consumer spending, Anne-Marie, just has not fallen off because of the ability for higher income consumers to spend?
We continuously hear about this bifurcated economy, but the Fed has two levers really only to deal with it, one economy, and that's the inflation side of the mandate and the job side of the mandate. Incredibly difficult moment for them because the higher end consumer is spending, and they're spending a lot more on all of these items, even if they're trading in once in a while for some deals when it comes to Walmart.
Which also speaks to this question that Bill Dudley rose, which was very interesting to me, Danny, because we haven't heard that much of it recently. Should the inflation target be higher? Will they allow a wider band in terms of inflation in order to allow for some equalizing on the bottom line? It becomes a tricky kind of push-pull because on one hand, inflation is the biggest tax on lower income individuals. On the other hand, high rates are the biggest tax on the lower income segment. So you're kind of stuck between a rock and a hard place.
Well, it comes back to the reason you're doing it is a preemptive rate cut, which Bill Dudley also argues for in that piece. Because even if the data is strong, even if upper income households are still spending a lot, there are still pockets of weakness that you can point to. And Neil Dutta and the team at Red Mac point out this, that you might have really good retail sales, but take-home pay was lower last month. And at some point, it's got to stop. The music needs to stop. It can't just keep happening indefinitely as people spend all of their savings.
What can keep happening indefinitely is an incredible amount of volatility. Last week was all downbeat. This week is all we're dealing with potential Goldilocks. The 6 straight days of gains left the S&P more than 6% higher. The NASDAQ more than 8% higher. Coming up next, breaking housing starts data. Former Labor Department Chief Economist Betsy Stevens here to react alongside Ed Yardeni of Yardeni Research. From New York, this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It was the way an August week should be, essentially pretty calm, if anything, very positive and happy. Everyone getting ready for a two-weeker before they head back after Labor Day. Right now in markets, you could see a bit of a turn, a little bit of a decline softening after that six-day rally with S&P futures lower now by 0.3%. We also see in the bond market a bid in with yields lower ahead of that Fed symposium in Jackson Hole, led by the two-year. Right now, we're getting some housing data. Michael McKee with us here, Bloomberg Economics and Policy correspondent. What do we got?
Bad news on a housing standpoint, because housing starts fall by 6.8%. The forecast was for a 1.5% decline. Last month, they grew by 3%. Building permits also down by 4% after a 3.9% gain in June. The forecast was for 2%. So it looks like at this point that builders are not confident in their ability to either sell these houses or to get them built. If you look at the charts for the number of houses under construction, they've come way down at a time when they're having trouble finding construction workers. So that may be part of it. But also affordability is difficult, and it's just not a good housing situation. And I know, Anne Marie's all over this. This is more of a political issue at the moment than even an economic issue, because everybody is upset that they can't buy houses.
Well, yeah, and especially if there's a younger generation that has no affordability or no entry point into the housing market. Just quickly, actually, the response in markets is notable. You're seeing some of the declines extend in the equity market ahead of the open. In bond markets, you see yields go even lower. It does seem like maybe on a quiet summer Friday, people are just trading on anything, and if it's a slight bit negative, you get the sort of knee-jerk, bad for stocks and good for bonds. It does raise this question, though, Mike, about how much of this really does reflect a housing market that is stuck in two very difficult places. On one hand, you have the idea that it is getting more costly and difficult to build houses and less optimism there. On the other, affordability is really low considering how high rates are and the inflexibility of people to actually move.
Yeah, the Fed is going to be lowering interest rates, and that will help with mortgage rates, but mortgage rates won't go down to the 2s anymore, or the 3s. The mortgage people did a survey this week that said people aren't really going to start refinancing or taking out new mortgages till we get to 5 or below. So that'll take a little while. And then the primary issue is we don't have enough houses. There aren't enough houses to buy, and there aren't enough houses being built. And so from a political standpoint, the candidates want to talk about ways to get more houses built. That's going to be the major issue.
Well, it's one of these things of how is this cycle different from other cycles? And previously, when mortgage rates came down, you did see housing prices come down because there was enough supply and people could get to them. Of course, the supply picture isn't there. And realistically, how do you do that at a time when housing builders don't want to build houses because they're not sure the demand is going to be there?
It is difficult. They know the demand is going to be there. I think it's a question of when the demand is there. And if the builders don't want to be stuck with inventory that they had to work off. They did that for the last couple of years because they went into the COVID era building a lot of houses, and then all of a sudden people wanted to move and they built more houses, and then people stopped moving because COVID kind of went away. And now we're at a situation where there's, in a couple of years, a lot of property coming online, not enough, but a lot coming online. And around the country, not in New York City, but around the country, that depresses prices.
With the sentiment yesterday being downbeat in the housing market and the data today, is it surprising? Because everyone is expecting the Fed to cut rates. Shouldn't it be moving in a better direction?
Well, you could argue that, but at this point, people aren't seeing it. I mean, rates have come down quite a bit. We're in, 6.5, down from 7, and still moving lower.
People are refinancing.
And there is a slight move towards refinancing, but there aren't a lot of people who have rates that are that high that they can refinance. And what we're basically living through here in terms of affordability is the consequences of having low rates for so long. Mortgage rates went down so far that everybody refinanced or got new mortgages at very, very low rates. And why do you want to move? And that clogs up the housing market.
Michael McKee, stay close. Thank you so much for being with us, and we will be with you in ample time next week at that Fed symposium. I'm so pleased to say, joining us now, former Labor Department Chief Economist Betsy Stevenson, also a Bloomberg Opinion columnist. Betsy, wonderful to see you. Thank you for being with us. We're going to get into what we can expect for Jackson Hole next week, but before we go there, I'd love your reaction to some of the housing conundrum that is increasingly percolating itself into policy proposals, putting aside what's actually been proposed, which a lot of people said is not going to see the light of day. What do you think is an appropriate policy reaction to try to create a more even playing field in the housing market?
I think that there are a couple of things that really need to be done. And so you can actually listen today when Kamala Harris gives her speech about housing, whether she addresses these. But one of the things we have to do is just get housing built faster. And that's going to mean cutting through some of the red tape. Everybody really wants to make sure that only certain kinds of housing goes up around them. All of this not in my backyard type policy. And you have communities that really slow down the process of building housing. We want to, really need to speed that up. We need to make it easier and cheaper. And we're also, we need to make sure that there are the incentives in the system for building affordable housing. And so we're looking for making sure that there are policies in place that are really trying to put their thumb on the scale to give builders the incentive to want to build something that is affordable. And then the third thing I think we really are going to have to address is what I call mortgage portability. We have people locked in to mortgages that are under 4%. We're not going to see that again for a long time. And they're stuck in their houses. They're baby boomers stuck in big houses that need to downsize, but they can't afford to downsize because they give up a really affordable mortgage. What we could do is make it so they could take their mortgage to the next house to try to get rid of some of this mortgage lock. Because if we don't do something to address the mortgage lock, I think we're going to be stuck with that for quite some time.
Wow, this was something that was actually done in the 1980s in a certain way to allow people to have some portability. Is this something that you're actually hearing anything concrete about?
That idea of mortgage portability is, I'm just going to say very clearly, not something I'm hearing concretely coming from any of the campaigns. I think what you'll hear more about from Vice President Harris are ways to incentivize the building of more housing and making sure that housing isn't becoming more of an investment commodity by big corporations that buy up lots of housing and push the prices up. That's one of the concerns you've seen out of the whole Biden-Harris administration is the corporatization of certain sectors and how that affects affordability for everyday Americans. But at the end of the day, I think what you just asked about, what do we do about mortgages? I think that's got to be part of it because the Fed is not going to cut rates enough that you're going to be able to go back to those locked-in mortgages that many people, including myself, have with a 30-year mortgage locked under 3%. I don't want to go anywhere. I don't need to go anywhere, but I know people who really should downsize, and they've done the math, and they literally pay more to buy a house that it costs, half as much because of how it would change their mortgage rate. I do think that's a policy issue that I'd really like to see addressed by by Vice President Harris at some point.
Betsy, to your point, though, that's not the conversation right now. The conversation, or at least the proposal that we're likely to hear today, is give $25,000 to 1.4 million new homeowners and try to get 3 million, incentivized via taxes, 3 million new homes to come onto the market. I know the likelihood of that actually coming to fruition is one conversation, but I want you to just take that proposal at face value. How successful will that be at achieving some of the things that you're talking about without creating distortions in the market?
You know, there's a lot of families that don't have the seed money, the down payment necessary to make a purchase. And it's become harder to come up with that down payment because you're just spending your 20s and 30s paying your student loan debt. And then you might want to have kids. And then you've got the very, very high cost of early childhood education, of daycare. When and how are you supposed to save up to be able to put a down payment down? So I think she wants to address that problem. Of course, what economists would say is, well, wait a minute, if we hand out more money to a housing market with pretty fixed supply, do you know who gets that money? The people who own the houses. And so you have to, if you're going to do a policy like that, it's absolutely essential that it gets paired with expanding the supply. Otherwise, literally all the money just gets captured by the people who already own the housing. So I do think that there are some reasonable policies in there to try to expand the supply of housing. I agree with you to say, like, look, you've got to get all this stuff passed. You've got to get the tax credits being proposed passed. You've got to get some of the red tape that's being proposed being cut, actually cut. And some of that red tape is not at the federal level. Most of it is actually at the local level. So how do we get local communities to do that? I will tell you that New Zealand had one of the highest housing price crises, I think, and it's very confusing. New Zealand, they got plenty of land. Why are their houses so expensive? And what they did was they cut the red tape, cut it substantially, and they saw housing prices actually come down. So it is possible to do it. Building more housing is always the answer. It always works. The question is, can we actually get those incentives into the system, passed into law, and make sure that we get the expansion that's necessary to to actually get what they're claiming we'll get, which is more housing and therefore cheaper housing.
Betsy, the Biden-Harris world want to be viewed as the competent camp, although their proposals, people are saying, are pie in the sky, and frankly, some of them wouldn't even work, like price gouging. Then why aren't they talking about things that you're talking about, like cutting red tape?
So, first of all, I think they are talking about cutting red tape. And, junk fees was a big issue for the Biden administration. And I think that was one that was particularly close to Vice President Harris's heart. And, that's not government red tape, but that's a different form of red tape, right? We're all confused about the prices because somewhere in, some fine print beneath what you're buying, it says, oh, by the way, it's actually another $40 for this hotel room because we didn't tell you about this extra fee, or for this flight, or, for all sorts of things. So I think they understand that Americans want simplicity, and simplicity requires cutting red tape. It requires eliminating junk fees. It requires making sure that that the market's operating fairly. On price gouging, when I first saw that, I'm like, oh, okay, yeah, we all roll our eyes and say, oh, we can't fix prices. But at the same time, telling businesses that they need to slow their roll and they don't need to be jumping prices by large amounts at a time, that's not necessarily going to be bad. And I think particularly with the limits on rent increases, it makes a lot of sense. If you're sitting there and you get a notice that says your rent's going up 50% in a month or 2 months, you might not have a plan. You might literally find yourself on the street, because how do you come up with that kind of money that quickly? So making sure that, no one needs to raise rent that fast. We have a lot of forward looking. We're watching here right now. We're learning all about the economy. We can form expectations about what's coming, and we can make a good plan that allows there to be slow price increases. Price gouging has always been against the law. And I think what you're hearing is, can we do a better job of enforcing it? But I will agree with you that there are trade-offs, right? When we say, no, if you're a hardware store with shovels stocked and a big snowstorm's coming in and you triple the price of those shovels, you'll get it, but it's a jerk move. And at the same time, what might happen is somebody who decides, maybe I want a second shovel in case one of my kids wants to help out, buys the shovel because the prices didn't go up, and then their neighbor doesn't get any. Right. So those are the trade-offs, right? And what they're saying is, I think we've leaned a little bit too hard on the price gouging end, and let's try to get some balance back in this market.
Former Labor Department Chief Economist Betsy Stevenson, thank you so much for taking the time. We really appreciate it. So that's the policy and the potential kind of ramifications. Really important to get a sense of where we are now in terms of the economic strength, especially heading into Jackson Hole next week. Joining us now, Ed Yardeni of Yardeni Research. And Ed, I just want to start there. I mean, there are a lot of proposals for how to make things better and to bring down inflation. How much is the Fed going to respond to the weaker side of things, or how much is the Fed going to respond to the strength and the resilience in sort of not needing them to have to cut too far?
Well, between now and the next meeting in September, we're going to get an employment number. And I think that employment report that we will get in early September, and that'll be for August, will reverse some of the weakness that we saw in July, which I think was to a large extent weather related. And if that's the case, that'll be one reason for the Fed not to do 50, but to do 25 basis point cut in the federal funds rate. In addition, we'll get a couple more inflation numbers between now and that meeting, and they should continue to confirm that inflation has moderated. So I think it all points out to 25 basis points, not some of the hysterical talk about needing 50 to 75 basis points, which we saw last week.
And why can't I make the argument, though, that going at 50 makes sense because we're so far away from the neutral rate that just doing 50 means that you just get closer to that. It's not something like an emergency cut, but it's just to get back to not being so restrictive.
Yeah. Well, I'm not a big fan of the neutral rate because it's a fantasy. Nobody knows exactly what it is. You can't measure it. You can't see it. There are people who use statistical models to try to estimate it, and it always seems to be changing. I think at the end of the day, we just have to see how the economy is actually responding to where interest rates actually are. And I think that the Fed has actually normalized interest rates where they are currently. The economy is performing fine. There are clearly pockets of weakness in the economy. I call them rolling recessions. But overall, the economy has grown by over 2%. In the second quarter, on a year-over-year basis, it grew by over 3%, which is kind of a normal growth rate for the economy. So why mess with success? The big risk in lowering interest rates aggressively is that you get a stock market melt-up. And the consequences of that is we then might be following it with a stock market meltdown. And I don't think we need to have those kind of excessive moves in the financial markets triggered by the Fed being a little bit trigger happy in terms of lowering interest rates.
Ed, if they do a cut and it's a big one, say 50 basis points, would that not signal to the market, though, potentially the Fed knows something, the market does not, and actually the economic conditions are deteriorating faster than people are expecting?
Yeah, absolutely. And by the way, it was only a week ago that there was all this talk about needing 50 to 75 basis points. If the Fed actually had on an emergency basis lowered interest rates, that would have worsened the crisis, because a lot of that was the unwinding of the carry trade that was going on a global basis when the yen was too strong. So if we lower our interest rates by more than necessary, and meanwhile the Japanese economy is looking pretty strong, and they go back to raising rates, we're going to get another carry trade. These central bankers have to be careful with the power that they have.
And I got to say, you are the one who really coined roaring 20s. You've been bullish on U.S. equities for a long time. Your biggest flaw just hasn't been maybe being bullish enough in terms of having to upgrade your forecast. So now the question is, do I hear a sense of change from you, that you're getting more cautious now ahead of a sort of, I don't know, threading a needle that seems like it's maybe not being threaded in the right way?
No, a few weeks ago, I raised my number for the S&P 500 from 5,400 to 5,800 by the end of the year. I still feel pretty comfortable with that. I just don't want to see us significantly exceed that, because I think that's melt up kind of territory. Already valuation multiples are really quite high, but yeah, honestly, we've achieved a lot of what I expected we'd achieve this year. I wouldn't mind if things just kind of simmer down a little bit. And I think they will. I think, we still have a presidential election up ahead here. We still have a lot of geopolitical risk, though oil prices are down a lot this morning. But I think by year end, we'll have another solid rally that'll probably take us up to 5,800, new record high.
Do you think, Ed, that we could see that 5,800 target achieved even with bond markets selling off in akin to basically what you're calling for, which would just be one rate cut? Currently, it's much more getting priced in.
Well, that's right. But I think the trade-off is going to be that the reason for the bond yield coming down of late, and at least until recently, the weakness in the stock market was a perception the economy was weak. I think we're going to see that the economy is actually doing just fine in coming weeks. So I don't really have a problem with the bond market continuing to be somewhere between 3.5% and 4% for a while. But I think the economy can withstand 4.5%.
Ed Yardeni of Yardeni Research, always wonderful to speak with you. Thank you so much.
Thank
and
you.
Have a wonderful weekend. Up next, setting you up for the week ahead, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young Black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There, counting you down to the opening bell for the last trading day of the week. Here is the trading diary for the day and week ahead. At 10 a.m., we'll get University of Michigan sentiment. And around 1 p.m., Fed speak from Chicago's Goolsbee, who was speaking earlier this morning with NPR. At 2:45, Kamala Harris delivering campaign remarks focusing on her economic agenda. We will bring that to you on Monday. This is when it all begins for the Democratic National Convention in Chicago. President Biden set to deliver an opening speech on Tuesday. Earnings from Lowe's and Toll Brothers. Wednesday, we'll get Target, Macy's, and TJX earnings before the opening bell. And Fed minutes coming out at 2 p.m. Thursday, the Jackson Hole Economic Symposium kicks off, plus another round of jobless claims. It's a lot to get through. S&P U.S. PMIs also on Friday. Fed Chair Jay Powell delivering those key remarks. Danny, In that panoply of potential events, what are you most focused on?
It has to be Jackson Hole. And the thing I'm most interested in is not necessarily what Powell says, but what everyone else around him says. Because we've started to see this coalescing of FOMC committee members who are saying the time is right, that the risk is not going soon enough. The risk is waiting too late. And I say it's most interesting to hear everybody because of the conversation we had with Steve Rasciuto earlier this week, that because it's September, because we're heading into an election, they can't be seen as political in delivering a cut. And in order to not seem political, they need to have everybody in agreement that now is the time to cut.
I guess that Jackson Hole probably is what you're watching too, Anne Marie?
No, I'm going to be in Chicago at the DNC, although I'll have one eye potentially on Jackson Hole to see what Jay Powell says. Because to Danny's point, it really is going to be potentially, through the eyes of some, they're going to look at this through a political lens, whether or not they go 25, 50, or cut at all when it comes in September, especially from the Republicans. We've already heard that from the former President Donald Trump, that they shouldn't cut ahead of an election. When it comes to the DNC, for me, it's really what happens after the DNC. Of course, there's going to be a tremendous amount of excitement and momentum at the DNC as they basically coronate Kamala Harris as the Democratic candidate, hopeful for them that they want her to be president. But what happens after? We actually have to see her sit down across from a journalist, not at rallies, and answer questions and details about these policies that they're throwing out.
All I can say is, and please forgive my skepticism, I hate saying this, but at what point can we take any policies, either from the Harris camp or the Trump camp, as anything serious, if none of them are going to see the light in the day and all of them are trying to pander to a particular constituent?
Well, I think you have to take what Darryl said pretty seriously, which is that fiscal policy is going to expand whether or not we have a Republican or Democrat. What they spend on, what they prioritize is going to be different, but also that will only matter when we know what the composition of Congress is going to be. And then also tariffs. Regardless of who wins, some level of tariffs will be in play.
Which raises a question about bond market volatility. To me, this is what I'm watching. How volatile are bond markets? Because all of these events disproportionately affect bonds than they do stocks. How much are we looking, Danny, at an asset class that has a volatility that has traditionally been the haven, stable, steady as she goes type of securities?
And how especially vulnerable are we that we all just loaded back up into bonds? The JP Morgan survey showed the most net long on the Treasury market for the year so far. What happens when we maybe start to believe some of these policy agendas saying there is going to be a lot of spending, and does below 4% on the 10-year make sense?
Coming up on Monday, Lori Calvasina of RBC, Kelsey Barrow of JP Morgan, Jim Caron of Morgan Stanley, and Mike Schumacher of Wells Fargo. Have a wonderful weekend. We'll see you next week. This was Bloomberg Surveillance.
Huge upsets on day 4 at the Cincinnati.
Okay, you're deep in the jungle, hanging with a friendly jaguar. Or how about in outer space, playing the bass? Let your imagination run wild with the new generative AI tools in Adobe Photoshop. Create anything you can dream up just by typing a text prompt. Treehouse in your jungle? Unicorn in your spaceship? Just type it. This changes everything. Hit the banner or go to Photoshop.com and try it for free.
Finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number 1, they do everything in teams. Their operations, their patients they see is all team focused. Number 2, they value process, but they hold themselves very much accountable to execution. They understand that It's good to explore a patient, but what really matters is that you take the tumor out. And then number 3, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Stocks have turned around to the downside. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. Bloomberg Open Interest starts right now.
Coming up, stocks are on course for their best week of the year, but a weak reading on the housing market is derailing the rally. Also, caution from Austin Goolsbee, the Chicago Fed president, says the labor market and some leading indicators on the economy are flashing warning signs. Amid all of this, the yen carry trade is staging a comeback. ATFX has seen a 30 to 40% rise in yen shorts in the past week. Let's take a look at where markets are trading at the moment. In terms of futures right now, we do see down arrows. That turnaround happened after we got the housing starts number and building permits, both disappointing compared to the expectation. We see S&P futures down 0.5%, NASDAQ futures off 0.5% as well. And investors are pushing down the yield on the 2-year, still above 4% at 4.03, 4.04. Katie?
All right, if you take a look under the hood here, we do have some pre-market moves to talk about. We start with H&R Block, posting better than expected results and raising its quarterly dividend by nearly 28%. That's not enough to lift the stock pre-market. Shares currently down about 0.9%. You also have Applied Materials out with earnings, meeting analyst estimates, but in the red, as you can see, after issuing a disappointing fourth quarter outlook. We're also, of course, keeping a look at NVIDIA. Shares this week jumping double digits, flirting with the biggest weekly advance since May of last year. That certainly helped to lift up the broader index altogether, Matt.
All right, let's take a look at what's going on in terms of the economic statistics this morning. We got on EcoGo on your Bloomberg terminal. Look at housing starts, a little bit disappointing. Building permits, a little bit disappointing as well. And maybe the problem is that this feeds negatively into the economy in terms of investment. A little bit later, in just about an hour's time, we're going to get University of Michigan consumer sentiment and the inflation expectations. We'll be paying close attention to that, and so will our first guest. Invesco Chief Global Market Strategist Christina Hooper joins us here on set. Christina, great to have you here. These markets are reacting in, I think, maybe an oversized way to each of these data points. It's not normal that housing starts would turn us around from 0.5% gains to 0.5% losses in futures, and yet today that's what we see.
Well, absolutely. And I think part of the problem is that we now see risks balanced, or in my opinion, I think the recession risk is higher than any kind of risk that we have a resurgence in inflation. And so as a result, markets aren't exactly sure how to react to data points. It was a lot easier to say bad news is good news. Now, bad news, we're not sure what it is. And I think that's part of the problem and adding to the volatility. But for me, I am focused on inflation expectations this morning because I think it's an important part of the Fed's calculus. We want to make sure there are no obstacles in the Fed's way. There's nothing they can point to when they meet in September because they need to cut rates.
They need to cut. Is 25 basis points going to be enough? Because that seems to be consensus. I know for a short, couple of days, people kind of were freaking out, but now everyone has come back down to that a little bit more, maybe in terms of what we're seeing the market price in, but economists are pretty certain about that. What's your view?
I think 25 basis points is enough to start, and it would be very appropriate for the Fed. Thinking about 2022 when they went to tighten, even though they were behind the curve, they started with 25 basis points. They quickly accelerated, but I think to save face, they started with 25, and I think they would follow a similar tack this time and start with 25, and if necessary, cut more in the following meetings.
Can we actually back up? Why do they need to cut rates? I mean, as Matt mentioned, we heard from Austin Goolsbee this morning saying that he's starting to get a little bit worried about the economy, about the labor market. Do you share that view?
I do. I think we're starting to see cracks form. It's largely among lower income households, but it is significant, and I think it is likely to spread. So every day we have monetary policy as restrictive as we have it today increases our recession risks. I think there's no other way to look at this. I don't think we have to worry about some kind of resurgence in inflation. I think that's very unlikely. I know the Fed is reluctant. Jay Powell doesn't want to be another Arthur Burns, but the reality is that he needs to be far more focused on recessionary risks.
And so wrap this into how you position a portfolio around this. This is a Fed that needs to cut rates. Every meeting that they don't, the risk of recession increases. I mean, do you start hedging for that recession possibility, or do you really have faith here that the Fed will deliver?
I think you hedge for that recession possibility, but I have to say it is not my base case. And so my positioning would be focused on smaller caps, cyclicals, an assumption that markets will discount an economic reacceleration at some point late this year, early next. But that's the purpose of diversification, is to hedge your bets, right? And so I think there needs to be exposure to defensives. Within a fixed income portfolio, it's important to have exposure to a variety of different sleeves, from municipals to investment grade to higher quality, high yield. All of those can play an important role. Some will work better in some economic scenarios than others, but I think it's carving together a portfolio that has a lot of diversification in an environment where uncertainty is rising is really important.
I have a viewer who's writing in with a question. How are you advising clients to invest over the next 4 months in terms of sector changes, asset allocation into other asset classes, maybe taking some gains off the table?
I think the very tactical view, 1 month ahead, would be more defensive. I think we're seeing a fair amount of volatility. We've got a relative strength indicator that has bounced back from 30 to close to 60 on the S&P 500. So I think in the very, very short term, defensive makes more sense. But I think opportunities are going to present themselves, especially if we see more volatility, especially if we see more sell-offs. And that has a lot of potential to offer openings for those who are significantly overweight cash. And there are many portfolios where there's a very significant overweight to cash. This fall might be present a lot of entry opportunities.
And let's talk about some of the known unknowns when it comes to positioning and some of the technicals. And I'm talking about the yen carry trade. Of course, that unwind certainly spooked markets over the past couple of weeks. One of the most read stories on the terminal right now is about how that carry trade attracting hedge funds again. How worried are you? Do you think that we're past the bulk of the digestion there, or is there still more to go?
Well, I certainly think that the future holds a stronger yen and a weaker dollar. Now, there are going to be some phases in this process, especially as we wait for the next moves by both central banks. So temporarily, I think there is that moving back into the trade, but I think ultimately it doesn't look attractive.
Christina, I mean, we've been debating about this, how deep do you dive into it? You're like an education junkie. I mean, you have a JD and an MA, and you're a certified, I'm looking at your CV, certified financial planner, certified alternative investment analyst, certified investment management analyst, certified financial consultant. I mean, how deep do you dive into this kind of opaque world of carry trades and try and gauge whether it's 75% unwound or whether it's coming back by 30 to 40%? I mean, how much does it matter?
I actually don't think it matters too much. I think we have to recognize that it presents the potential to create more volatility. Look what it did just recently. And so I think we have to recognize that this could happen again. I think it's hard to have that precision. There's a false precision in setting exact targets and coming up with specific numbers for something like this, as well as even targets for the S&P 500. I think it's much more appropriate to get it right directionally, to understand what the threat might be and what it might do.
So really quickly, just to sort of tie a bow on this, I mean, if we do see more of that volatility, given there's debate as to how much it actually matters, does it actually affect fundamentals? Would those be buying opportunities if you saw it, take down NVIDIA by 7% again?
Well, I certainly think triggering a sell-off presents buying opportunities, especially in an environment in which we have the Fed poised to start cutting. And I think, especially once they start cutting, we're in an environment that's much more, I think, supportive of risk assets. So it could very well present a buying opportunity. For individual stocks, it's harder to say, but I think in general, there's going to be some sell-offs in our near future, and that is likely to be a buying opportunity.
All right, Christina, it's always great to see you. Really appreciate you taking the time on a Friday morning. That, of course, is Invesco Chief Global Market Strategist Christina Hooper. And we do want to bring you some breaking news right now. This out of the political realm. Howard Lutnick named a Trump transition team co-chair, of course, in the event that Donald Trump does win the presidency again. Linda McMahon also named to that transition team as a co-chair there. We're going to continue to follow that story, bring you more details as we have them, but it's a busy day in the markets right now. Let's get a check on futures. The S&P 500 currently lower by a hair in the pre-market, down about 0.4%. A little bit more if you take a look at the NASDAQ 100. Same thing, too, at the Russell 2000, those small caps. Of course, we had disappointing housing starts. That seems to be taking some of the momentum out of the enthusiasm that we've seen at the index level this week. But let's take a look under the hood now. We're going to do that with Abigail Doolittle.
Well, starting off with one stock that is dragging, Katie, the shares of Bumble right now down 3.7%. This as Cowen has cut the shares to a hold from a buy on the company's uncertain recovery path. Per their research, they say that the near-term opportunity is unclear given the gradually worsening paying trends plus industry headwinds. Into today, the stock already down about 60% on the year, so clearly in a world of hurt, and there is a 13% bearish short interest, so there's bears really winning. Turning to a stock that's doing a little bit better, though, quite a bit better, actually. Planet Labs up 9.3%. They are putting their first hyperspectral satellite, Tanager 1, into space, along with 36 Super Doves. They will launch on the Transporter 11 rideshare mission with SpaceX and expand by 400 spectral bands of data. And then finally, Lumen, these shares lower by a significant amount, almost more than 4% here. Wells Fargo has cut the stock on their weakening legacy revenue, They are saying that the private connectivity is a better reward, but in terms of that legacy, Matt, it creates an overall less favorable risk-to-reward ratio.
All right, very interesting stuff. Abigail Doolittle, thanks very much. Coming up, we're watching Rivian as the EV maker pauses production of those Amazon delivery vans due to a supply chain issue. We'll talk tech with Ed Ludlow next. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. VP Kamala Harris is set to propose sweeping new federal subsidies for lower-income Americans, parents, and home buyers, alongside new programs to curb increases in rent and grocery prices. Her plan includes expanding the child tax credit to $3,600 from $2,000 per dependent, with a supersized $6,000 credit for newborn babies. Meanwhile, Donald Trump is trying to reset his campaign as he loses ground in the polls. Corey Lewandowski and Dan Murtaugh are back from his 2016 and 2020 campaigns, respectively. And breaking just moments ago, Howard Lutnick has been named Trump's transition team co-chair, along with former World Wrestling executive Linda McMahon. The two will chair his transition into the White House should he win. Meanwhile, back in the world of business, Texas Instruments is set to receive a $1.6 billion grant in the CHIPS Act grants and $3 billion in loans as well. The announcement came from the Biden administration and will help the company pay for one factory in Utah and two in Texas, with 2,000 more manufacturing jobs expected as a result, if it actually gets built. Katie?
And sticking with chips, Applied Materials, which is the largest U.S. maker of chip manufacturing equipment, it delivered an in-line sales forecast for the fiscal fourth quarter. But investors clearly were looking for a bigger payoff from AI spending. Bloomberg Technology co-host Ed Ludlow joins us now with shares down about 3% pre-market, Ed. And of course, when we're talking about Applied Materials, they're a key supplier to Taiwan Semiconductor, Samsung, Intel. And I guess those companies just weren't spending as much money as maybe investors hoped.
Yeah, it's not that Applied Materials did anything wrong. In the third quarter, it was pretty decent, and beat on most metrics. But the street has very high expectations that all of the capital expenditures going into infrastructure right now, particularly relating to AI, is going to have ripple effects for everyone. Applied Materials is not at the sort of lead cutting edge of machines that make those top-end AI accelerators. That's ASML. But there are lots of other ways that it could be involved. For example, when we see high-bandwidth memory kick off from Samsung, SK Hynix, and Micron, they provide machines for that. So the guidance was fine. It's just that at the high end of the range, people thought it would be a lot better than it was. And it just shows there's probably a while to go until this massive boom happens, or indeed that it's continuing at the pace we expect.
It's pretty amazing that they're not getting enough orders for the automotive business when, Ed, auto sales haven't slowed down, and you know that the number of chips needed in every car just continues to climb to eye-popping amounts.
This is the data to track for the bigger picture. We don't have crystal balls, but it's as close as you can get to it, looking at the chip equipment makers. Because if you look at Applied Materials commentary and results, it's consistent with what NXP told us, that more cyclical industries, like the companies that make chips for cars, are sort of giving off sluggish demand vibes. And that's very interesting because you're completely right. The number of control units in any given EV is a lot. But at the end of the day, it's a sort of confidence thing. And it tells us that in the end market for automotive chips, they're probably not as bullish or in a full investment mode as perhaps we thought they might be at this stage of the cycle.
And Ed, switching gears here, you're not just an anchor, you also write stories as well, and you break news.
Sometimes.
And you broke some news last night when it comes to Rivian. This is interesting, pausing production of the EV commercial van that it makes for Amazon. What's going on there?
Yeah, there's some sort of parts shortage, which happened at the beginning of August, immediately following the quarterly earnings that they just reported. I don't know which part it is, but essentially, they've just stopped the line until it comes in. You know, it's an example of the kind of disruption that Rivian continues to have to deal with. Importantly, there's no sort of material impact to guidance, right? The line in Normal, Illinois is capable of building about 15,000 of those things you see on your screen. They have a surplus of them anyway. If you fly to Chicago and you drive the 2 hours to Normal and you get to Rivian's factory, you'd see hundreds of them on the concrete outside because Amazon's been pretty chill about taking delivery of them, frankly. And what's interesting is that in the final 3 months of the year, Amazon's busiest period, they actually hold off taking delivery of new vans and expanding their fleets because they're just too busy dealing with holiday traffic and packages. So it's like teething problems, but I want to know more about what's going on. And I think investors set a really high bar for Rivian because of all the names on the cap table, the holders, the amount of cash they're burning through. And it just shows they're not immune to what's going on around the world.
Well, much more coverage coming up on Bloomberg Technology with Ed Ludlow a little bit later on. Appreciate your reporting
More
as
scoops.
always. More scoops. Rivian currently down about 1% pre-market. Now coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, H&R Block reporting a strong fourth quarter that beat Wall Street estimates. The tax prep company also guiding for another year of revenue growth. Shares flying right now, currently up almost 10% pre-market. Next up, Bank of America is adding to its list of sports sponsorships with a deal for the FIFA World Cup. Bank of America will be the first banking partner for the event in 2026, and the bank plans to have a physical presence across the host cities to tap new and existing clients. And finally, AST Space Mobile is confirming an early September window for its inaugural commercial satellite launch. The telecom company says that the satellites will be the largest ever to be deployed commercially in low Earth orbit. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal map.
All right, take a look at what's going on in the markets right now. We had futures up just about an hour ago. Then we got housing starts out. That data disappointed, as well as building permits. And as a result, we are now pointed down just about 7 minutes into the open. One of the other big deals in markets, definitely the last couple of weeks, but it seems to be re-emerging, is the carry trade. And I want to talk to Damian Sassower about that. He's Bloomberg Intelligence Chief Emerging Markets Credit Strategist. And I thought of you, Damian, as I was reading about all these EM currencies that are swirling around. Like, the carry trade is an abstruse thing. We can't really put our fingers on it or wrap our hands around it. You can't really measure it, but Nomura was out today saying that it's back on right now as borrowing in the yen is being traded into higher yielding currencies. What's your take?
Well, you really can't measure it, but of course I try to, right? So let's talk about the debt of Japan. And we're not talking about the $4 trillion in Bank of Japan debt. We're talking about $20 trillion if you include GPIF, the biggest pension fund, and all the state-owned banks. And let me tell you something, all of them are positioned outside of the country in non-dollar assets. So what you're talking about is that repatriation of yen back on shore. And what that did is it caused this massive unwind. Traders were caught the wrong way, et cetera. But look how quickly it's come all the way back. And it's not just the yen carry trade, it's all leverage positions for that matter, Matt. It's payers in the US Treasury market, steepeners, flatteners, all of the curve trades. A lot of that came off, a lot of that's coming back on. You've got the VIX now down below 16. And what I'm finally seeing in terms of currencies, not just in developed and emerging markets, are finally paying attention to monetary policy. So we've had 19 major emerging and developed market central banks, announce on rates over the better part of the last month. 9 of them have cut. So now what you're seeing is those who really can't afford to keep interest rates this high are basically cutting rates ahead of the Fed, and their currencies are taking a hit for it.
Another good word for the carry trade, I think, is nebulous.
Yes.
Is another good word. That was the word.
Yes, that's the word you used, and I thought that's a great way to describe the carry. Thank you.
I got a lot of words, but we were talking about this with Christina Hooper, and she said, zooming out, the path of the yen is stronger versus the dollar. You think about that divergence that you're talking about between EM and DM. You think about just the Bank of Japan versus the Fed. Those two are diverging.
Right. Well, I think what you have to do is you have to decompose exactly what generates a total return in a carry trade. Well, there's two components of it. There's movements in the spot FX rate, which is what we're seeing and what we're talking about with yen now back below 150 and approaching 140. I don't even know where it is today. And the interest rate component. And let me talk about that interest rate component for 1 minute, because let me tell you something. Yields in Turkey are 50% overnight. Yields in Brazil are 10.5%, and they're over 10% in Mexico. So, when you talk about, the carry component, the interest rate return on these carry trades, it's significant because of these yield differentials, and that's not going away anytime soon. So I think what we're seeing is a reversal. People putting back on the carry trades. If you listen to them more and some of these others, and I expect that to continue.
Just got about 45 seconds left, Damian. We got a viewer writing in and asking, if the Fed cuts rates, does that force the hand, I guess, further of the other global central banks that you're watching?
Well, at least they're not asking about my jacket. I'm on radio today. But let me just talk about this. If you're talking about really Fed movement and what that means for the rest of the world follows the Fed. Some of these central banks are trying to get ahead of it, which is what we're seeing over the better part of, the last week. New Zealand, the Philippines this week. Next week, we're going to see Sweden probably cut rates again ahead of the Fed. But really, at the end of the day, it's other countries who started cutting, like Brazil, who are now pausing. Other countries like Mexico who are not moving as quickly as we otherwise have thought. And again, these are countries whose policy rates, their overnight rates are over 10%. So, on a relative basis, you've still got 500 plus basis points of carry cushion that's going to save the day.
I know you're on radio and YouTube with Tom Keene right now doing surveillance. I know you're with Tom because you quoted the VIX. And he's never had a Walter's hot dog. Did you know that? I heard this morning, I will listen to you guys on the way in. Tom has never had a Walter's hot dog.
I don't know what that is.
The greatest hot dog in America.
You split it, they cook it in butter. It's delicious.
Made in Mamaroneck.
Oh, it's great
Celebrating
stuff.
their, I think, 105th year anniversary. Just delicious.
Is that fat-free?
Damian Sassower, thanks very much. It's fat full. All right, more on these falling markets coming up. We're going to talk to Linda Dissel when we come back. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
We are moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We saw a real turnaround in futures this morning. We were headed up. We're still on track for a weekly gain, big weekly gain, but we do see futures now lower. S&P futures off about 1/3%, a little more. NASDAQ futures also off about that much. There you hear the opening bells on the New York Stock Exchange. You've got what looks like Q2 ringing the opening bell. And on the NASDAQ, Smokey the Bear, 80th birthday. That's excellent. He's quite young, actually. I would have imagined he was older. Only you can prevent forest fires. Let's get a quick check on the major averages this morning as we kick off the session here. S&P 500 down about 1/4% right now. NASDAQ 100, so the bigger tech stocks down 0.5%. The small caps on the Russell 2000 down a little bit less than 1/4%. One of the stocks that we're watching at the open is H&R Block. Earnings there beat estimates in the fiscal fourth quarter. H&R Block announced a $1.5 billion share buyback as well as a 17% dividend increase. So giving money, returning cash to shareholders, that's what the market likes to see. There you can see the full quote. Let's get over to Katie Greifeld right now. Katie, what are you watching?
Yeah, not as rosy if you take a look at Applied Materials. We were just talking about this with Ed Ludlow. Of course, the chipmaker sales forecast, it came in line with estimates. That's good news, but the bar was really high. Shareholders clearly looking for bigger returns on the AI investment. Shares currently off about 4% just a couple seconds into the cash trade. We also want to take a look at NVIDIA's week because the stock rose by more than 12%, of course, lifting the S&P 500, lifting the NASDAQ, also bringing the company's market value above the $3 trillion mark. Let's take a closer look now with Bloomberg's Abigail Doolittle.
Yeah, lots of rally action this week, Katie, for big tech and the markets overall right now. Yesterday, actually, I should say, we had these indexes up 6 days in a row. But take a look at tech on the week. Super Microcomputer gaining 22%, basically in a bull market after having dropped in a bear market. NVIDIA, I don't know whether or not it's still in a bear market. I suspect it's not. But the degree of the bear market, probably this stock may still be in a correction from its peak. We'll be taking a look at that chart in the 10 o'clock hour. Micron up 14%, Broadcom. So you see this broad rebound for the chip space as investors are buying the dip from that big sell-off induced in part by too far, too fast, the yen carry trade. Let's take a look at technology relative to the other sectors because we are going to see this massive outperformance, up 8%, the best week since 2022. Discretionary, there's also some big tech in there. Financials, healthcare, and then you can see that the more dividend dividend-oriented, rates-oriented sectors on bottom. Real estate and utilities not even up 1%. So big outperformance for tech. One question, though, is will it last? There are some similarities to the monthly chart of the NASDAQ 100 to 2022 out of the 2020 pandemic low. You can see this big rally. The RSI overbought for a period of time, but then it started to cross it lower. It didn't happen all in one stroke in 2022. It took some time. Well, take a look at this massive rally that we've had for the NASDAQ 100. Interestingly, similar to into 2022, the trend reversing. The point of a trend line is not to see the trend, it's to see when it reverses. The RSI starting to come out of overbought. It suggests at some point, Matt, that the big tech strength that we've had this week, well, that may not be the case.
It's amazing how overbought it was, though, Abigail, in 2022. And we were talking this morning with Christina Hooper of Invesco. She mentioned the RSI as well. We're not quite there yet, right, where we were in that last big rally.
Yeah, we're not there, and it's unlikely that we will be. So that was truly overbought, to your point, between in June of 2021 into 2022. Right now, we were right above 70, now at 69, which really points to the uncertainty. Not quite as robust here, but still a pretty tremendous rally. Last year, the first half of the NASDAQ 100 up 40%. That was the best first half for the NASDAQ 100 ever. So lots of steam rising there, and now it seems to be evaporating a little bit. It's going to be interesting to see whether or not we have something similar to what did happen in 2022.
All right, we'll definitely keep our eye on it. Abby, thanks so much. Abigail Doolittle taking you through the technicals. Let's bring in Linda Dissel right now, Senior Equity Strategist at Federated Hermes. Linda, we've seen an incredible bounce back from the Manic Monday that we had last week. What are you doing right now? I mean, I think a lot of people used that drop to get back into tech stocks that they'd sold off. At least the 13F showed us that a lot of big hedge funds had taken some profits. Where are you positioned?
Well, good morning. Thanks for having me. The VIX that spiked was a kind of a rare spike. It was an extremely rare decline from that spike. And history suggests that when the VIX goes spikes like that, you should expect some more tremors before you think you're out of the woods. So we're suggesting still that, you know, even though it's all over the map as to whether this carry trade is over, your commentary about what's going on in the technology sector is very interesting. And like, it seems like every quarter we need to bite our nails as we wait and see what NVIDIA tells us in terms of their earnings and their outlook. And that can also just on its own be a time to pull back yet again. So we think we're still going to have some volatile months now.
Yeah, NVIDIA doesn't report until August 28th after market. That certainly will be a lot of fun. But let's go back to the carry trade, the nebulous carry trade that we've been talking about. It's extremely technical in nature. It's not going to alter the fundamentals of an NVIDIA, for example. And Linda, with that in mind, if we do see more volatility around the carry trade, fears of that unwind, is that a time to really buy that dip?
Well, you know, again, the numbers as to how far we are through the unwind of this carry trade are all over the map. So it's hard to really suggest that that bit of it is done. It's probably largely done, but because these names, these technology names are so widely owned all around the world, it's hard to believe that, you know, one couple of day trade is you're done. It's really hard to believe that, and it seems impossible for the experts to really pin down whether it is, which is why I bring up earnings season anyway. Regardless whether people bought on the dip or not, people still heavily invested in the large caps tech sector, which we like, and we like the broadening of the market. We're simply suggesting that more volatility is likely to come as people are on edge, traders are on edge. It's the summertime trading environment and the like.
How confident are you? I mean, this earnings season has been very strong, 11, 12, 13% growth in terms of profits, and the rest of the S&P, after you take out the mega cap stocks, which has been in an earnings recession for the last 6 quarters, is finally turning a profit. Do you expect that broadening to continue in the second half?
Well, yeah, it's very, very interesting. The broadening is such a great thing to see because it gives you more confidence that it's not just a handful of names. And indeed, it's been a much stronger second quarter than many thought. We've suggested that we're going to watch profit margins and see what the guidance is. So the guidance that came out of the second quarter, you saw a more broadening of companies reducing their guidance. You've seen a more broadening of companies raising their profit margins. 2/3 of the companies had profit margins up in the second quarter, which is great news. But you've seen for third quarter earnings per share expectations brought a broadening of bringing that down. So it could be kind of a pivot moment potentially, or at least let's not get too excited to continue to extrapolate. It's just one of those things. It's much like the jobs market. Are we having a problem or not in the jobs market? Are we having a problem or not in the retail sales environment? It just, things are staying stronger for longer, but we're all just biting our nails for the flip over. And third quarter will be interesting.
Yeah, well, that's where I wanted to go. And you talk about this nail bite moment. I wonder if we're seeing the high water mark, because already you're starting to see some Q3 estimates come down for earnings, depending on which measure you look at.
Yes, indeed. Depending on what number you look at, the earnings figures for the second quarter were 11-12%, and that's being brought down to 6%, maybe when all is said and done, maybe 8%, but a decrease to be sure. So we are expecting that more of this concern will start to eke its way out into the into the various parts of our economy and our markets. But still, we think, look, we have a 55-20 figure for this year end in the S&P, and that's where we're at right now. That argues for continued volatility on the downside, strength after the election, and we have a 6,000 target for next year. So a broadening of a slowing, but still no recession is kind of our bottom line.
All right, Linda, that's a good place to leave it. Really appreciate you taking the time. That is Linda Dissel. She is Federated Hermes Senior Equity Strategist. Have a great weekend. Now, coming up, with Mpox being declared a health emergency, we speak to Dr. Seth Lederman. He is the CEO of Tomix Pharmaceuticals, which has a vaccine candidate for the virus. That conversation coming up next. This is Bloomberg.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
All right, let's take a look at what's going on in the market right now. Just about 13 minutes into the trade, we are still down only about 0.1% on the S&P 500. We had been up this morning, and then housing starts came out in a disappointing way, building permits as well, and as a result, we turned around. The NASDAQ 100, the big cap tech stocks, are lower right now, and the Russell 2000 is gaining. So a little bit of a rotation this morning, Katie.
A tiny rotation. We'll see if it can build a little bit, but it's time now for our top calls. Some Leannis action in focus this morning, and first up, Wells Fargo going all in on Fox with a double upgrade from sell to buy. The analyst attributing his bullish call to the company's sports streaming opportunities. Next up, Bank of America says that Estee Lauder no longer a buy. The firm downgrading the beauty giant and cutting its price target by $40. The analyst cites weaker than expected performance in China. And finally, TD Cowen cautioning investors on Bumble as it cuts its buy rating on the online dating site. The analyst cites an uncertain path to recovery thanks to fewer users, the lack of other portfolio brands, and broader challenges in the online dating space, Matt.
All right, let's get to an issue that has been popping up on the most read for the last few days, and that is Mpox. The World Health Organization has declared the fast-spreading Mpox outbreak in Africa a global health emergency, and now as the variant changes, it leads to more challenges trying to contain it. The Director General spoke about his concerns.
WHO has been working on the Mpox outbreak in Africa and raising the alarm that this is something that should concern us all. The emergency committee met and advised me that, in its view, the situation constitutes a public health emergency of international concern.
Joining us now is Dr. Seth Lederman, CEO of Tonix Pharmaceuticals, which has a vaccine in development for the virus. Doctor, really appreciate your time this morning. Tell us about this vaccine. I believe it's not in human testing yet. So is it likely that you get it through testing and out in time, I should say, to contain this virus?
Yes. First of all, thank you for having me on. We've done advanced animal testing, and we're ready to start manufacturing. And we are glad that WHO has declared Mpox a global health emergency of international concern. Our vaccine at Tonix is a live virus vaccine, and that allows us to vaccinate potentially many more people at a lower cost. And we think it has the capability of making an impact on public health.
And how long do you see the threat of Mpox remaining? And I mean, extrapolating that out, how big do you think the market could potentially become here?
Well, it's frightening to think about it, but 2 years ago was the most recent public health emergency involving Mpox. And in that, 32,000 Americans have become infected, and it's now endemic in the United States. But this new strain, Clade 1b, which, by the way, was first detected outside of Africa in Sweden yesterday, is expected to come to the United States. This is believed to be more contagious than the Clade 2 that infected 32,000 Americans in the past 2 years, and also approximately 20 times more lethal.
I remember when we were at the start of the COVID outbreak, and Angela Merkel, the Chancellor of Germany at the time, said she thought 60 to 70% of the population could get it, and that sounded insane. Of course, now we've all gotten it. Can Mpox get this bad?
Well, we're still learning about the transmissibility of this Clade 1b variant, but it does seem to be more transmissible than the Clade 2 variant. In the United States, the Clade 2 variant was mostly restricted to men who have sex with men, But in Africa, monkeypox, about 50% of the deaths are in children. So this is not technically a venereal disease, but it is transmitted by contact and also potentially by aerosol. So I can't guess right now how widespread it will become in the United States, but it is hard to imagine that it won't spread in the United States. And in fact, we really don't know. The HHS said yesterday they don't believe that Clade 1B is in the United States yet, but we did, as far as I know, the CDC is not actively testing.
And I want to talk a little bit more about your specific vaccine and the trial that's underway. What type of trial is this, and when might we expect results to be published?
Right, so we haven't started a trial yet. Now we're reinvigorating our efforts because, frankly, interest in Mpox was maintained at Tonix, but not by health authorities or investors. So we're ready to jump on and get going again. But the difference is that ours is a live virus vaccine. It's a modern form. We call it a fourth generation, similar to the vaccine that Edward Jenner introduced in 1800, but we believe with much better tolerability profile, much better, 10,000-fold in animals. And this, when Jenner's vaccine was used to prevent smallpox all over the world, that actually kept Mpox out of the human population. So we think from a public health point of view, a live virus vaccine has the ability to block forward transmission and to be work with only one dose. And that's a big advantage, both in the United States and other countries.
Well, Doctor, we'll definitely keep an eye out for that trial start. Really appreciate you taking the time today to walk us through it. That, of course, is Tonix CEO, Dr. Seth Lederman. Now coming up, best known for buy now, pay later loans, the fintech firm Klarna eyeing an IPO. More details next in our Wall Street Beat. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on where stocks are trading at the moment. Right now, the S&P 500 getting towards little change, getting towards unch. We had been up about 0.5% on futures, then down 0.5% after the housing starts came out, and now we're looking very little change here, but still up bigly for the week. The NASDAQ 100 down about 0.3%, the Russell 2000 gaining The S&P has been on quite a tear this week since it had such a disappointing Monday last week. Then it was unchanged at the end of the week. Right now we're up 3.6% for the week.
And we do have, of course, some data coming at the top of the hour. University of Michigan sentiment coming out. Of course, we're moving on every single data point right now. It'll be interesting to see what happens. But it's time now for our Wall Street beat. Swedish fintech Klarna is setting the stage to be one of the biggest U.S. IPOs of 2025. The CEO joined Bloomberg earlier this morning about the company's future.
We're probably going to hit over $1 billion in revenue in the U.S. pretty soon. So, and that has obviously made sure that we are doubling down our efforts to accelerate rolling out new services in the U.S. as well. But especially when you talk about things like bank license, it does take some time, right? They took us a few years to get our European banking license, so we don't want to make the dependency on the IPO to that.
And for more on Klarna's growth and their plans, I'm thrilled to say we're joined now by Bloomberg's Bailey Lipschultz, who covers IPOs and everything else. And Bailey, you're on set on a Friday, which is a treat in and of itself.
You're in the office on a Friday.
Well, I'm co-hosting Bloomberg Radio from 10 to noon, so if you get bored of this,
With Alex Steele?
With Alex Steele, yeah.
Oh, you're a lucky guy. Well, you have about 6.5 minutes here. Tell us a little bit about Klarna and their plans. Does 2025 sound realistic?
I mean, it could be. When I talk to bankers, though, 2025 is kind of being chalked up to a lost year in the sense that you're coming out of the August lull. If you want to go public, you have to do it after Labor Day. You're really kind of threading the needle between that and the U.S. election. Do you want to go right before Thanksgiving, or do you want to try to, again, Thanksgiving this year is on November 28th, so when you look at the calendar, it's pretty choppy. So the bulk of activity when I talk to bankers and executives and investors is likely going to happen in the March to May timeframe next year.
So it's less likely, in your opinion, that they actually go in 2025, but they'll be big, right?
They're big.
I imagine if it's one of the biggest U.S. IPOs, that means it's going to be one of the biggest global IPOs.
It would be. We don't know what the logic or thinking could be, but right now we're seeing, in Bloomberg's reported, Klarna could target a valuation of $20 billion. So if you kind of slice and dice how many shares they offer and kind of what they want that float to be, that'll be interesting. But when you got to look at this company, you got to keep in mind, they did a funding round in 2022 at $6.7 billion. That was a sharp drop from $45.6 billion. So what this logic looks like, what the thinking looks like, what the messaging from the company and from bankers, kind of how that plays out when you, at least from a public investing standpoint, your best comp is a firm, which is down more than 80% from its 2021 peak.
So we're going to continue to keep an eye on Klarna here, but let's talk a little bit more about the end of this year. Like you said, a lot of difficult needles to thread there between, all the holidays, the election, et cetera, et cetera. Is anyone else notable expected in the pipeline for the rest of this year?
We've reported names, the likes of a StubHub, the likes of an Ingram Micro. It's going to be interesting to see kind of what the receptivity is of investors when we get closer to potentially launching those IPOs, but it really feels like the others, the insurance names, the healthcare names, that's really what's going to make up the bulk of the post-Labor Day window.
All right. Bailey, thanks very much for joining us. We look forward to your radio show from 10 to 12 on Bloomberg Radio with Alex Steele. I want to take a look at gold. Let's take a longer-term look at gold because the intraday chart is going to show you a little rise to 2496. 2500 is the level that it hit just a few minutes ago. And here's a one-year chart. This shows the incredible climb that we've seen in gold at a time when, especially in the last half of the year, when Bitcoin really didn't help during the Manic Monday, flash crash. Gold continued to remain steady.
There's your hedge right there.
Coming up in the next hour, Liz Ann Saunders joins us of Charles Schwab. We're also going to talk to Evite CEO Ann Defoe. Stick with us on Open Interest. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the weekend. I'm Alex Steele alongside Bailey Lipschultz. Paul Sweeney is sunning himself at the beach today. We have a great show lined up for you. In just moments, we'll talk to Joanne Shu, who heads up UMich, the survey just breaking right now. Sentiment a little bit better, but current conditions not so great. Later on in the hour, we're going to talk to Sam Fazeli of Bloomberg Intelligence to discuss the latest on Mpox and what kind of vaccines we could expect there. Plus, Anna Cabral is Sigma Lithium co-chair and CEO. She'll be joining us. It's green lithium. How do you do that profitably? We'll be breaking that down in just a moment. On a day, I don't know. I don't even check the markets. What are we doing? It's not that. Okay, volume's light. Now. It's flat. Okay, so I'm justified here. So Bailey, welcome. I'm so excited to host with you.
Hanging out with you. Paul Sweeney Summer Friday season finally kicking in, allowing me to sit in the chair. Market's potentially going to trade, I guess.
I'm very excited for these next 2 hours, and I hope you guys are too. So let's get right now to a business flash, and for that, we go to John Tucker.
Yeah, Alex, and your favorite indicator, University of Michigan.
You mock me, but it's true.
I didn't mock you. I know you're a geek. Better than expected, the headline number. I'll go right to the inflation expectations numbers as you dig deeper a little in a few minutes. One-year inflation expectations higher than expected, 2.9%. It was 2.8%. It's actually matches the prior month's reading, and the 5 to 10-year inflation expectations, 3%. Matching the prior expectation, the prior reading of 3%, and better, I would say higher than economists forecast. We are data dependent, and with the housing starts disappointing investors earlier today, we are off the highs of the session. The S&P 500 right now up just 2 points, kind of flat trading today. Dow Jones Industrial Average up 61 points. That's a rise of 0.2%. 40,623 on the index. And the NASDAQ 100 right now is down 46 points. The VIX, Wall Street's fear gauge, falling below 16. But Christina Hooper of Invesco is of the mind that market volatility isn't going to go away.
I don't think it's completely in the rearview mirror. I actually think that this is going to be part and parcel of the next several months. There's an awful lot of uncertainty out there, and that certainly can be a force moving stocks up and down. We just don't know when the Fed is going to act, how quickly it's going to act.
And it's worth noting small caps outperforming today. The Russell 2000 is up about 0.7%. Two-year yield right now, 2 basis points lower, 4.07%. And the 10-year yield pretty much unchanged at 3.90. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Bailey and Alex.
Thank you so much, John Tucker. Appreciate that. Let's get more on UMich, my favorite indicator. Joanne Shu is University of Michigan Surveys of Consumer Director, breaking down these numbers for us. Joanne, it feels like it's a non-mover, really. Like everything is status quo. Can you walk me through what you see in these numbers?
Absolutely. So overall, it is essentially flat from last month. However, that does obscure some pretty substantial movements within the population. First of all, election news has been really dominating the headlines, and we see that in our data. Sentiment for Democrats improved 6% this month, but this ended up being offset by a 5% decline for Republicans. And these movements were entirely in expectations, which is sensible given that election developments, Kamala Harris becoming the new nominee for the Democrats, is not something that affects current assessments, but is something that affects people's outlook for the future.
And how can we expect that to evolve as we get closer to the election, since we are still only in mid-August?
It's going to be volatile, or that's what I would expect. So far, consumers are really folding in who they think is going to win the election. But of course, as the campaign season evolves, people's expectations for the election are going to change. And as such, their future expectations for the macroeconomy will as well.
What are some of the other things that you noticed, just in terms of either future expectations or current conditions, I should say, which did improve?
Yeah, current conditions really didn't move much at all. And if anything, it edged down just a little bit. Consumers continue to be very frustrated by high prices. That continues to be top of mind. At the same time, consumers do expect inflation to continue stabilizing. They weren't really reacting to a CPI print or any data that came out this month. They were really already folding in their experiences throughout the month, their own experiences, shopping and seeing the prices around them.
And just looking at the report, so we see 35% of respondents expect unemployment rate to rise in the coming year. Growing number expect interest rates to pull back. How does that kind of impact consumer sentiment and kind of where we could be in the coming months?
So consumers aren't really that concerned right now that labor markets may be softening. So the 35% expecting unemployment rates to go up, that's unchanged from last month. So that's pretty stable. Income expectations have edged up, improved just a little bit, or have gone sideways. There's no weakening in consumer views of labor markets in August. That being said, strength in labor markets is precisely what has supported robust consumer spending over the last 2 years, in spite of the fact that consumers don't feel like they're thriving. And so if there is some unraveling in labor markets, some softening in labor markets, I would expect consumers to pull back.
All right, Joanne.
That being, yeah.
Oh, no, finish up. Sorry.
Yeah, and part of the reason why that consumers, I think, feel some confidence about labor markets is that they do expect interest rates to come down in the year ahead.
Which leads us right back to the Fed. Hey, Joanne, we do appreciate it. Thank you very much, Joanne Shu, University of Michigan Surveys of Consumer Director, joining us on those numbers as sentiment came in a touch better, current conditions a touch lower, and expectations a touch higher as well. And markets reacting in kind. We still have a little bit of a bid into the bond market. Equities go nowhere fast. There are some individual movers, though, that are a little bit interesting here. And Norma Linda joins us, Bloomberg Equities reporter on this. Now, you're looking at B. Riley Financial. This has been a drama over the last couple
It really has. I mean, to put it plainly, it has really been in the trenches. So, of course, today, seeing the stock a bit higher is very welcome news. But this is coming days after its suspended its dividend, it announced its biggest ever quarterly loss, and confirmed that the SEC is investigating the business. But today we're up. We have shares soaring as much as 35%, which is the most that the stock has seen since April. And this is coming after Bryant Riley, who is the co-founder and largest shareholder of the company. He informally offered to buy shares that he does not currently own. He's saying that he will offer to buy the stock at $7 per share, which is a 40% premium to yesterday's close. This is to be financed by debt and possibly equity as well. But of course, this is still far off from where it was trading about a year ago. It was trading about $50, and now, of course, we're here talking about a deal of $7.
Yeah, I love the rallies, Nora, because we sit on the same desk. You know, a 25% pop takes you back to the highest level since Wednesday, which
right,
is
since like 2 days ago.
Right.
Yeah, so do you guys just like sit on the equities desk and be like, hey, do you see this move?
we
Isn't
look
that
at
cool?
lines. Yeah, we talk about lines moving up and down. You can't really, like, B. Riley, like Nora mentioned, if you pull up a 12-month chart, was it $52? Like, you can't really put that in perspective too well.
I mean, we do the same thing on the TV desk. It's just, we're just as nerdy, just maybe in different ways. All right, let's talk about AMAT, Applied Materials. Their earnings like weren't terrible yesterday. Like it was a solid actual quarter. But so what is weighing on the stock?
I mean, the bar continues to be incredibly high when we think about AI and what expectations are from the investor perspective. We're seeing shares of Applied Materials slipping as much as 5% in trading this morning, and this is after its forecast underwhelmed the bulls. So as you mentioned, its fourth quarter forecast was in line with expectations, but those who were looking for top end and a really great payoff when it comes to AI prospects were not delighted by this report. Its fourth quarter sales is expected to be $6.93 billion, which did match estimates, but this is still considered to be a middle-of-the-road sales forecast.
Yeah, we're looking at one of the worst performers in the Philadelphia Semiconductors Index, which is only down 0.5%. And Nora, I think Alex said some interesting movers. I think H&R Block is kind of a boring company, but what's going on with that?
Okay, so do you all file? My question: do you file your taxes on your own, or do you go and get?
I pay a guy.
You pay a guy.
No, I pay a guy. I'm an adult with a kid and a property. Yeah, I pay a guy.
Too much to do. So are you going to H&R Block or somewhere else?
No, I go to some place that it charges me too much. As one does. Well, I had complicated taxes for a year. We had a mother-in-law passing away. There were
you don't have to go into this. As your attorney, I would advise you not to.
Well, shares of H&R Block are rising as much as 19%. This is the highest that it's seen ever. And of course, it does seem like some customers are going toward H&R Block, and it is seeing its biggest gain since 2022. This is after a revenue forecast beat for 2025. They are notching up what they expect their outcome to be for the next year. And we have analysts who are really rallying behind the stock, saying that this is good news coming out of the company here.
I just want to say, H&R Block has returned 80% in the last 12 months. If you told me to pick what H&R Block shares were doing, I would probably say flat.
Is that like lawyers and tax attorneys? Like, are those like the two, or tax people? Those are the two that are going to be left standing?
Maybe so. We'll have to see.
I guess so.
Yeah, pretty much. All right, Nora, thanks a lot. Really appreciate it. Norma Linda joining us on the Bloomberg Equities team. All right, let's get a professional in here now and talk about how you think about these markets after the volatility that we've seen in the last couple of weeks. But if you went on vacation 2 weeks ago and came back now, you didn't really miss much at the end of the day, which is also kind of crazy. Shayna Sissel joins us. She's president and CEO of Banrion Capital Management, and she joins us now. Shayna, isn't that funny? 2 weeks ago, it's like it never happened. I mean, that kind of rebound in the S&P is quite striking. How does that set you up now for the next couple months?
I always say the best thing we can do for clients sometimes is maybe take away their password to their brokerage accounts so they're not checking it every day, because if they didn't, they would sleep a lot better at night for that exact reason. The market has short memory these days because we have so much information out there in the 24-hour news cycle. But I think the volatility, Professor Siegel was on another network earlier this week, taking back everything he said when the panic set in. And if the professionals that, investors look to for guidance are inclined to panic, I think that says a lot about kind of the overall sentiment and psychology of the market right now. So it doesn't surprise me that, as information became available, people stopped freaking out about the yen carry trade. But it doesn't change the fact that we are in a slowing economy. we've had good data, and so I think people feel confident the Fed is definitely going to cut 25 basis points in September. And I think that if you are a long-term investor, that there's some opportunities when people freak out like that to take advantage of, the psychology of the market and buy things at a discount.
Shana, Jackson Hole next week. What are you looking for from Jay Powell? What can he say that can either reinforce the view that we're going to get a 25, if not a 50 basis point cut, or could he even kind of throw a wrench into things and maybe push that further out again?
I can't imagine where he's going to throw a wrench in things. I do think that 50 basis points is a stretch. There's not enough data that suggests that we need to do a larger than expected cut. And I think the Fed is cautious to not do something so abrupt and significant that it would upset the overall market sentiment, as I've noted a couple of times, does matter. And I expect that he will continue the same narrative that he's had for quite some time, which is that the economy is stable. It's doing okay. The data shows that it's slowing down and softening, but not of concern, and it supports a 25 basis point cut. And I think that's what he'll continue to say. I've watched him long enough now to know that he's not one to very quickly change his tone. And the last time he was out speaking, he was, not necessarily overly dovish, and I don't expect him to suddenly become overly dovish.
Which, to be fair, most other Fed presidents aren't either. So there's that as well. So we're kind of wrapping up the earnings season. We got some retail that's trickling out. Obviously, NVIDIA is going to be a big event at the end of August. But what stocks do you like after we're kind of past the real hump of earnings season, headed into an election cycle where policy will be very unclear?
Yeah, so I have kind of a wide variety of different types of stocks that I like. I like a name like Atlas Holdings, which is a commercial insurance firm. I followed it for a while since my days at Ariel, and it's a really interesting company with a really unique niche that is trading at a discount and has some relatively attractive upside. Pretty boring. It's in financials, so people, it's not sexy like NVIDIA or any of the AI plays. VRT is an AI play, but it's a second derivative of traditional AI. It's data center cooling, which is really important because in this growing AI demand and more people looking to incorporate it, you need greater computing power. And thus you need a lot stronger or a lot more powerful cooling systems, of which VRT can bring to the table. I also like Novartis, which is a healthcare company, so I'm a little all over the place. I'm happy to go down any one of those roads for you. But I am trying to find ideas outside of what has been the hot trend, because you want to get into other areas when you start to see dispersion of returns, which we have seen a little bit of, and you want to take advantage of opportunities to be a stock picker.
So, yeah, I guess kind of when you look at how you're playing AI, you mentioned Vertiv. I covered them when they went public through a SPAC. So you're looking at kind of these derivative plays when you're thinking about implementation of artificial intelligence and who can be the winners or losers?
Yeah, that's exactly what I'm doing. I'm someone who's followed and loved NVIDIA and been talking about NVIDIA now for years. And it has served me well. I've made a lot of money for clients and in that stock. And I'm still very much bullish on the stock. I think the trends are very favorable for the long term, and we're still very early in the AI cycle. That said, I don't think it can maintain the growth rate that it's had going forward. Now, 100% growth is still really impressive, but when you were at 300% growth, it feels a little disappointing. And so I'm trying to find other ideas that will benefit from AI. Vertiv is one of them. I've talked a little bit about Cisco in the past, and I know they're all in the news with the announcement of their layoffs. But that's another player that has some second derivative exposure in AI as well. and trading very cheaply, and obviously making some unattractive or unpopular decisions internally, but typically those decisions are made to improve overall financial performance. So that's another name, but it's not on my buy list, but it isn't another like second derivative play.
Yeah.
And that's kind of what you have to look at this point.
Hey, Shana, really appreciate it. That's such a great point about Cisco. Shana Sizzle joining us. She's president and CEO of Banrion Capital Management, joining us there. So just a quick check here. So those of you who follow the show know that Paul likes to rib Bailey on his outfit choices because he does the bro vests and he has like a whole closet full of bro vests.
Occasionally, I dabble.
But now there's no bro vest. It's a suit jacket, just for those of you listening on radio and not YouTube. So I'm confused.
I had to be professional.
It's a bro vest opportunity.
I guess so. Maybe next time.
Okay.
When I'm filling in.
All right, we're going to go through all that. All right, Sam Fazeli, Bloomberg Intelligence, will be joining us next on the MPOX and sort of how to defeat that. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. Just a little hiccup from Goldilocks. Stocks flat. New home construction fell in July to the lowest level since the aftermath of the pandemic. S&P 500 right now a little change, still poised for its best week this year. Among the individual stocks on the move, you have shares of Applied Materials. They're down close to 2.5%. The largest maker of chip manufacturing equipment in the U.S. slumping its sales forecast, disappointing investors. They were looking for more. NVIDIA, most actively traded stock today. The shares right now up 1.6% after being lower earlier. They report their earnings at the end of the month. Another thing to look forward to, Fed Chair Jerome Powell is going to speak next Friday at the Kansas City Fed's Jackson Hole Economic Policy Symposium, maybe giving some hints about the future rate path. And right now, we have the S&P 500 2 points higher. Dow Jones Industrial Average down 42 points. The NASDAQ 100 down just 2 points. Russell 2000, that is up 0.3%. 2-year yield unchanged, 4.09%. The 10-year yield right now unchanged, 3.9%. I'll just leave it there because it's kind of boring.
Hey, thank God for the Russell. Hey, woo, up to 0.3%. That's something. We got something there. All right, JT, thanks a lot, John Tucker. I'm Alex Steele, alongside Bailey Lipschultz. Paul Sweeney is sunning himself at the beach today. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance and economics through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries all around the world. One topic we wanted to tackle today was Mpox. So the WHO declared a fast-spreading Mpox outbreak in Africa a global health emergency as the agency seeks to contain the spread of the potentially deadly virus. WHO Director General sounded that alarm at a press conference on Wednesday.
WHO has been working on the Mpox outbreak in Africa and raising the alarm that this is something that should concern us all. The emergency committee met and advised me that, in its view, the situation constitutes a public health emergency of international concern.
Joining us now, Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst, is standing by. I hear you're in Bordeaux. I can only assume there's a lot of work happening there.
Oh, lots, Alex, lots. I haven't moved from this seat for the past 7 hours.
I mean, he could be telling the truth. Hey, Sam, when I heard I assume. When I heard the Mpox headline, I was like, I got to get Sam on. Like, give us the basics. Like, what is it? And how dangerous is it?
Yeah, so Alex, I think when the WHO Director General declares these emergencies, that's already quite a significant and important milestone for a disease. And as you know, it is already, there's been an individual in Sweden, apparently, that's been diagnosed with it. So, and as I said all along, infectious diseases are not about a country, they're not about a continent. They spread. That's the job of an infectious agent. So let's remember that as we talk through the rest of this conversation. What we've got here is not quite a replay of what we had 2 years ago, which was a slightly different version of this monkeypox virus. The disease is called Mpox now. And the virus comes in 2 flavors, clade 1, clade 2. That kind of looks at its, based on its genomic structure. And this particular one is clade 1, which is normally less often found. The last one was clade 2. And this clade 1 has got a major chunk of its genome that's been taken out. And those who study these things have been writing that it has made it more transmissible through not just contact with pus, for example, but also through sexual activity, which is not what clade 1 previously had, but also just very close contact. So unlike COVID, if you remember, there were stories with COVID where you go into a restaurant and you sit diagonally across 20, 30 feet away and you still have a risk of catching it because it gets blown around by the air conditioning. I don't think we're at that level with Mpox yet, with this particular clade 1b. I can't be 100% sure, but I don't think it's like that. You still do need the close contact, and that's where that's where my knowledge kind of ends at the minute. These viruses do have a nasty habit of bringing surprises to us.
Well, Sam, that's my next question would be, how quickly can this evolve, and what does kind of that look like in terms of similarities or differences to, as you mentioned, the 2022 Mpox, or something that's more kind of well-known, obviously, in COVID?
Yeah. So 2022, we still had 95,000 people who were infected. It did become a major issue in many countries. So let's not forget that. And so far, I from the last count I heard about, there's been 17,500 infections that have been documented in the regions that have reported it. How far can this go? It all depends on that mode of transmission. It all depends on, remember the days we went from a standard, if you want to call it that, coronavirus, SARS-CoV-2, to the Omicron variant, which had so many mutations that made it completely invisible to our immune systems. So everybody got another infection round. I'm pretty sure you do recall that last lockdown, I think it was.
Oh, definitely remember all that, Sam. Don't you worry.
Yeah, so, but I mean, it just feels like a really weird period of our lives. And so here we have something that if the rules are that it plays with are still the same as before, it does leave close contact, which means you should be able to avoid an infection if you're careful enough. The other element, of course, is that we do have vaccines that do work. There is a 600 to 700 million stockpile of smallpox vaccines around, both the older generation and new generation. And there are 2 mRNA vaccines in development that could be sped up if needed. So we do know that vaccination helps, but it does have a higher mortality rate standard to even the people who get it that are, that's not just like elderly people, which was mostly a COVID issue, than COVID did.
So it can kill more, and it can kill all different ranges, not just say the elderly, but we do have the vaccine. What about a treatment?
There was a treatment that actually it's being studied by a company called SIGA, and that just failed in trials only 2 days ago. And it was being tested in the Congo, and it was being against clade 1. But the silver lining of that report is that the mortality rate that they came out with was lower than what people talk about. People talk about 3 to 6%, but in that trial, mortality was like not small, 1.7% from what I have read. So that does give you a little flavor as to maybe it's not as bad, but it's obviously 1.6, 1.7% is still pretty awful.
And Sam, how kind of quickly can some of those vaccinations be deployed? Is that something that's already playing out right now? Is that being centered primarily where the heart of the outbreak is in Congo?
Yeah, it doesn't sound like it from the latest news reports that I've seen that Bloomberg has been doing a great job of talking about. That apparently there have been discussions, because this is not something that happened overnight. It's been going on, at least in the Congo, unfortunately, for a few months, and that there's been discussions between groups that provide the vaccines and the Congo, and they hadn't got to the last I read, to an agreement of getting those vaccinations out and getting it to people. Let's not forget, we've learned this. Anywhere you go, having vaccine is not equal to people having it in their arms. The more difficult a country, a region, reaching people in rural areas, etc., is, cold chain necessities, etc., the more difficult that is, the fewer people will actually be vaccinated. So that's 2 different things here. But I'm confident that we can have enough vaccines to ring fence at least infections and areas and travelers. But in order to go into the hundreds of millions of doses, I think we need the mRNAs to get going.
It's such a good point, Sam. That's why you're the best. Hey, before we let you go, I just want to hit you on this headline here. Pfizer and BioNTech, their flu COVID vaccine failed?
Well, talking about mRNA, here it's a complicated thing. It was a combination. mRNAs against 3 different types of flu and COVID. And it failed against one of the flu variants, which is or strains, which is the influenza B virus in that setting. So they need to go back to the drawing board and see why that is. What is complicated here, and we need to understand it better, is that they had a success in phase 2. Then they took the same thing into phase 3, and it failed against the influenza B. I've asked the company whether that's because they think that the strain changed during the trial. It's possible. Remember, flu is one of those nasty ones that changes all the time. And the change matters a lot more, I would say, than COVID does. So that's what happened here. And it does give them a disadvantage versus Moderna, which had a successful trial.
such good perspective. Sam, you are totally the best. Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceutical, joining us from Bordeaux. I look forward to the pictures, Sam. I require some of that just to see. Because do you make your own wine there? Like, do you have a... Oh, he's gone. He already left.
He's back to the vineyard.
He's back to the vineyard. Oh, same. Thanks, Sam. Really appreciate that one. Anyway, coming up, we're going to talk about, and welcome to my world, Bailey. We're going to talk about lithium.
Lithium. All right. You're a big fan of energy.
I'm a big fan of energy.
Okay.
I mean, I think we all like energy, but, like turning on our lights. But yes, I'm an energy nerd, if that's what you're referring to. So Sigma Lithium is a sustainable lithium producer in Brazil. A lot of the times you don't hear that together, sustainability and lithium. You need the lithium for the batteries for EVs. That's a no-brainer. So we're going to break down the company earnings and also what is this company, what is the growth, and is it cost-effective to actually have sustainable lithium? We'll be talking to the CEO and chair in just a moment. Equity markets going absolutely nowhere. Maybe everyone else is on the beach with Paul Sweeney. Here's Michael Barr, though, with World and National News. Michael Barr.
Thank you very much, Alex. Bailey, John. Vice President Kamala Harris will give voters a better idea of her economic policy during a speech later today in North Carolina. We'll carry Harris's remarks starting at 2:45 p.m. on Bloomberg TV and radio. Yesterday, Harris and President Biden announced the administration was able to lower the cost of 10 medications for Americans on Medicare. Former President Donald Trump is not backing off the personal attacks that even some of his allies fear may be going too far against Vice President Harris. In a news conference at his New Jersey golf club, Trump says he is entitled to personal attacks against Harris.
I don't have a lot of respect for her. I don't have a lot of respect for her intelligence, and I think she'll be a terrible president.
More on that from Bloomberg Government's Zach Cohen in Washington.
Every time I talk to members of Congress on the Hill, Republicans who are eager, obviously, to see Trump win back the White House and for them to retain control of the House and flip the Senate, their focus is always on policy. They want to focus on inflation. They want to focus on the border, the issues that for months have been the talking points for Republicans in their bids to take complete control of Washington like they had in 2017.
Bloomberg Government's Zach Cohen. International diplomacy to prevent the war in Gaza from spreading into a wider regional conflict is intensifying. The British and French foreign ministers made a joint trip to Israel today to push for peace. Meanwhile, internationally mediated ceasefire talks in Qatar ended for the second day, with many diplomats calling the discussions constructive. The new push for an end to the Israel-Hamas war came as Gaza health authorities say the Palestinian death toll in Gaza climbed past 40,000. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.